Most people think living off investments is something reserved for people who already have everything figured out. Like income only shows up after you're rich. But in reality, it's built the opposite way. Over the past couple of months, I've tested this from every angle, starting from zero, starting with $10 a day, starting with $70 a week, and starting with real lump sums like $100,000 and $500,000. I broke down simple ETF portfolios, growth versus income, how dividends stack, how taxes change results, and where future growth comes from. In this compilation, I've combined all those approaches into one place. That means there's something here no matter where you're starting. You'll see how small daily investments can grow into portfolios paying $2,000, $5,000, or even $7,500 a month. You'll see how the same $100,000 can grow toward $5 or $6 million, or instead turn into more than $25,000 every month in income. You'll see how weekly investing can build a seven-figure portfolio. The mechanics stay simple. The decisions stay manageable. The real difference is sticking with them long enough to reach the turning point. This is where it all connects. And the best way to understand how all this works is to strip everything back. If I had to start over today with what I know now, this is exactly where I'd begin. Let's say I lost everything tomorrow. No portfolio, no savings, just zero. If I had to start over in 2026 with what I've learned, I wouldn't chase hot stocks or try to be clever. I'd keep things simple and invest in ETFs. Most investors don't struggle because they choose the wrong investments. They struggle because they overcomplicate decisions that don't need to be complex. The real challenge isn't finding more options. It's knowing what actually matters long term. In this video, I'll walk you through a simple 3 ETF portfolio and explain why these specific ETFs cover what actually matters long term. I'll break down what each one does and how they work together. I'll also show you how this same portfolio can be structured for income or for growth using the same 3 ETFs without needing a whole new strategy. And at the end, I'll show you how one version builds a portfolio close to $1 million that pays over $2,000 a month in dividends, and another that grows to $2 million by focusing purely on growth. Before we talk about specific ETFs, we need a few rules that don't change no matter who you are, how much money you make, or what the market's doing. These rules apply if you're just starting, if you're resetting, or if you've been investing for years but feel like your portfolio doesn't quite match your life anymore. The first rule is that time decides emphasis, not investment opinions, not headlines, not what did well last year, time. When you have time ahead of you, the portfolio leans toward growth because your contributions are small relative to the time they have to compound. The second rule is that capital has to exist before income matters. This is where a lot of people get tripped up. Income feels productive because it's visible. You see cash hitting your account and it feels like progress, but mathematically, income drawn too early slows compounding. A portfolio that pays you before it's large enough is doing the job of a later stage portfolio too soon. You're asking it to support you before it's finished building you. The third rule is that volatility isn't the enemy people think it is, especially when you're contributing regularly. Volatility only becomes dangerous when it changes behavior. If you're adding money consistently, price swings actually work in your favor over time. You're buying more shares when prices are lower and fewer when prices are higher. The real risk isn't fluctuation, it's panic. It's stopping contributions. It's locking in losses because the portfolio didn't match your expectations emotionally. Now, this is where ETFs come into play, and I want to keep this simple. An ETF is just a structure. It's a way to own a large group of companies all at once, automatically, at a very low cost. You're not picking winners, you're buying systems that evolve on their own. Companies that stop performing fall out. Companies that grow become a bigger part of the portfolio. That automatic adjustment is a massive advantage over trying to manage everything yourself. When you apply these rules using ETFs, investing becomes about staying invested long enough for compounding to do its job. The goal isn't to be right this year. The goal is to still be invested 10, 20, 30 years from now with a portfolio that changes its emphasis as your life changes. With that framework in place, the question isn't how many ETFs you need, it's which few can handle different jobs over time without forcing you to rebuild the portfolio as your priorities change. VOO fills that role. It's the core holding that stays in place regardless of whether the portfolio is emphasizing growth or income. VOO tracks the S&P 500, which simply means it owns the 500 largest publicly traded companies in the United States weighted by size. When companies grow, they become a bigger part of the index and ultimately your portfolio. When they shrink or fall behind, they eventually get replaced. You don't have to predict which companies will win. The index does that work for you over time. When people hear that, it sounds boring, but boring is exactly why it works. The S&P 500 has survived wars, recessions, inflation spikes, interest rate cycles, tech bubbles, and financial crises. Entire industries have come and gone, and yet the index keeps moving forward because it constantly renews itself. The companies that drive productivity, innovation, and profits today are not the same ones from decades ago, and VOO automatically reflects that change. The math behind this is simple but powerful. Historically, VOO has delivered long-term share price appreciation of about 12.47% per year, while also paying a dividend that currently yields around 1.12%, growing at roughly 6.17% annually. Those numbers aren't guaranteed year to year, but over decades, it's been remarkably consistent. At the same time, VOO charges an expense ratio of about 0.03%. That means for every $10,000 invested, you're paying about $3 per year in fees. Compare that to actively managed funds that charge 1% or more, and the difference compounds into hundreds of thousands of dollars over a lifetime. This is why matching the market already puts you ahead of most investors. After fees, taxes, and bad timing, the majority of people who try to beat the markets end up falling behind it. VOO doesn't rely on being smarter, it relies on participation. As long as the US economy grows over time, this ETF captures that growth with very little friction. And this is why VOO works as the base for both types of investors. For growth-focused investors, it provides broad market exposure and long-term appreciation that compounds with time. For income-focused investors, it represents ownership in profitable businesses that generate real earnings and cash flow. The emphasis may change, but the foundation does not. VOO doesn't try to be exciting. It provides a stable base that allows the rest of the portfolio to do its job without carrying everything on its own. Once the foundation is in place, this is where the direction starts to depend on what you want the portfolio to emphasize, income or growth. Not because the rules change, but because what the portfolio is being asked to do changes. When growth is the priority, it naturally gets more weight. And that's where QQQ comes in. After QQQ, I'll show you one more ETF that completes this portfolio. Then I'll walk you through how these three ETFs can be combined to focus on income or on growth. And at the end, you'll see how one version builds a portfolio close to $1 million that pays over $2,000 a month in dividends, while the other grows to $2 million by focusing purely on growth. QQQ tracks the NASDAQ 100, which means it owns 100 of the largest non-financial companies listed on the NASDAQ exchange. In practical terms, this tilts the portfolio toward companies that are heavily focused on technology, innovation, and scale. These are businesses that tend to reinvest a large portion of their cash back into growth, whether that's software, data centers, automation, or entirely new products and services. The reason this matters comes down to one concept: return on capital. A company that can consistently reinvest its profits at high rates compounds faster than one that can't. Over long periods of time, that difference is massive. Even a few percentage points of higher annual returns, sustained for years, can mean the difference between an average outcome and a life-changing one. That's why growth-heavy ETFs like QQQ have historically outperformed broader market indexes over long stretches. In fact, over the last 10 years, QQQ has averaged an annual share price appreciation of about 18.45%. Of course, that higher return potential comes with higher volatility. QQQ will fall harder during market downturns, it always has, but volatility by itself isn't the risk most people think it is. Risk is being forced to sell at the wrong time. And when you're early in your investing life and contributing regularly, you're not forced to sell, you're buying. Lower prices simply mean your contributions buy more shares. This is where the math starts to work in your favor. If you're adding money consistently, downturns don't damage long-term outcomes, they improve them. You're dollar-cost averaging into volatility. Over time, the market recovers, earnings grow, and those extra shares compound. The only way volatility becomes harmful is if it pushes you to stop contributing or abandon the plan altogether. Historically, QQQ has experienced drawdowns of 30%, 40%, and even more during major market events, and yet, over long time horizons, it's still delivered higher annualized returns than the broader market. That doesn't mean it will outperform every year, it means that patience is rewarded when growth is the priority and time is allowed to absorb short-term pain. This is why growth-heavy exposure makes sense when the goal of the portfolio is maximum compounding rather than immediate income. The dividend stream is intentionally small because most of the return is coming from reinvested earnings inside the companies themselves. Volatility is the price paid for higher expected growth, and when growth is the objective, that price is rational. But this is also why growth should never be the entire plan forever. As portfolios grow and priorities shift, the emotional cost of large drawdowns increases. What feels tolerable at $50,000 feels very different at $1 million. Growth does the heavy lifting when appreciation is the focus, but it's not meant to carry the portfolio alone indefinitely. QQQ's role is not to replace the foundation, it's to accelerate it when growth is emphasized over income. It adds horsepower to the system during periods when compounding speed matters more than stability. And once that acceleration has done its job, the portfolio benefits from rebalancing emphasis towards income and stability using the same system rather than abandoning it. This is where a lot of investing conversations go wrong because income gets framed as either good or bad, smart or outdated. In reality, income is neither. It's simply a different priority. And this is where SCHD fits into the system. SCHD focuses on high-quality companies with strong cash flow and a history of paying and growing dividends. These are businesses that are already profitable, already established, and already generating more cash than they need to reinvest aggressively. Businesses like Coca-Cola, PepsiCo, Texas Instruments, Cisco, and Verizon. They're focused on consistency, durability, and returning capital to shareholders rather than chasing aggressive expansion. The mistake many people make is treating dividends as the goal from day one. The math doesn't support that. When a portfolio is small, the cash flow isn't meaningful enough to change outcomes, but the cost to compounding is real. Every dollar paid out is a dollar that can't compound internally at higher rates. That's why income-heavy portfolios tend to lag during the early years. But that doesn't mean dividends are useless, it means they solve a different problem. When a portfolio is small and you're still adding money, income doesn't change outcomes much. But as the portfolio grows and contributions become a smaller part of the equation, cash flow starts to matter. At that point, dividends reduce the need to sell shares to generate money. During market downturns, that matters a lot. Instead of being forced to sell assets at lower prices, the portfolio continues producing cash. That makes drawdowns easier to live with, keeps volatility lower, and reduces the chances of making emotional decisions at the worst possible time. That behavioral stability has real mathematical value. Staying invested through bad markets does more for long-term results than squeezing out a little extra return in good years. SCHD plays this role well because it's selective. It doesn't chase the highest yield. It focuses on balance sheets, payout ratios, and sustainability. SCHD carries a current dividend yield of about 3.77%, with dividend growth averaging 10.61%, while share price appreciation has averaged around 7.82%. That combination favors reliability over speed, which is exactly the point when income is the focus. Reinvested dividends buy more shares, which generate more dividends, which then buy more shares. Over long periods, that feedback loop adds up. More importantly, during market downturns, dividend-focused portfolios tend to fall less, which reduces the odds of panic selling when portfolios are large and emotions run even higher. This is why SCHD fits naturally when income and stability are emphasized. It's not there to maximize returns, it's there to support behavior, consistency, and sustainability without dismantling the growth engine that built the portfolio. And when you strip away the narratives and just look at the numbers, this is how the three ETFs compare. Each one excels at a different job, which is exactly why they work together instead of competing with each other. At this point, all the pieces are on the table. We've covered the rules, the foundation, the growth engine, and the stabilizer. This is where most investors get tripped up because they assume growth and income require entirely different portfolios, different strategies, different accounts, constant reinvention. They don't. What actually changes over time isn't the system, it's the priority. The same three ETFs can be arranged to do very different jobs depending on what you're asking the portfolio to accomplish. One version emphasizes growth, the other emphasizes income. They're not competing ideas, they're two expressions of the same system. To make this concrete, let's lock the variables so the comparison stays clean. Assume you're starting from zero. You invest $10 a day, every day. Dividends are fully reinvested. There's no market timing, no stock picking, and no tactical moves. Just consistent contributions and the same three ETFs working in different proportions. When growth is the priority, you allocate a larger share of the portfolio to growth-oriented ETFs. More weight goes towards assets designed to reinvest earnings and compound faster over time. This increases volatility, but with a long-term horizon and consistent contributions, that volatility works in your favor by accelerating portfolio growth. When income is the priority, you shift more of the allocation toward income-focused ETFs. Growth exposure is still there, but a larger portion of the portfolio is directed toward assets that generate steady cash flow and reduce drawdowns. Nothing else changes. You're not starting over, you're not abandoning growth or suddenly becoming conservative. You're simply adjusting the weights so each ETF does the job it's best at for that specific goal. That's why thinking in terms of portfolio expressions is so powerful. You're not changing strategies over time, you're using the same system to serve different types of investors. It's one portfolio structure built from the same three ETFs. The difference is simply what the investor wants the portfolio to do. A growth-focused investor uses this system to prioritize compounding and long-term appreciation. An income-focused investor uses the same system to prioritize cash flow and stability. The ETFs don't change, the rules don't change. So the real question isn't, am I a growth investor now and an income investor later? It's what outcome do I want this portfolio to optimize for? Now, let's look at the income-focused version of this same system and actually put numbers behind it. This portfolio is built for someone who wants their investments to produce steady cash flow and feel more stable, even if that means giving up some upside. Nothing complicated is happening here. It's the same 3 ETFs, the same $10 daily contribution, just weighted to favor income. In this setup, 20% goes into VOO, 10% into QQQ, and 70% goes into SCHD. That heavier tilt toward SCHD pushes the portfolio toward companies that consistently generate cash and return it to shareholders. Because of that, the portfolio starts with a current dividend yield of about 2.91%. Those dividends grow at an average rate of 9.61% per year, and even with income as the focus, the portfolio still averages about 9.81% in share price appreciation. Growth is still there, it's just not doing most of the work. To keep the comparison fair, the assumptions stay the same. You start from zero and invest $10 per day. That works out to $3,650 per year with dividends fully reinvested and no changes along the way. From there, the numbers build gradually. After the first year, the portfolio sits at $3,650. After 10 years, it reaches about $66,195. After 20 years, it grows to roughly $283,496, and after 30 years, it ends up around $992,646, just under $1 million. By year 30, this portfolio is projected to generate about $24,123 per year in dividends, which comes out to roughly $2,010 per month. That income arrives without needing to sell shares, and that alone changes how the portfolio feels during market downturns. Looking at where that value comes from helps explain why. About $883,146 of the final portfolio value is value added beyond your contributions. Roughly $688,105 comes from price growth, and about $195,041 comes from dividends being reinvested over time. Those reinvested dividends help smooth out the ride. This version of the portfolio is about reliability. It's built to generate cash, reduce emotional pressure, and stay usable even when markets are unpredictable. But that stability comes with a trade-off. When income takes the lead, total growth slows down. And to see just how big that difference can become, we need to look at the growth-focused version of the same system, built with the same $10 per day and the same 3 ETFs, but weighted for a completely different outcome. A growth portfolio is built for someone who doesn't care about income right now and is focused almost entirely on how big the portfolio can become over time. Here, 20% goes into VOO, 70% goes into QQQ, and 10% goes into SCHD. That heavier tilt toward QQQ pushes more of the portfolio into companies that reinvest aggressively and compound faster. The trade-off is volatility, but the payoff is scale. With this allocation, the portfolio starts with a much lower current dividend yield, about 0.92%. Dividend growth averages around 8.91%, and average share price appreciation jumps to roughly 16.19%. The assumptions stay exactly the same. You start from zero and invest $10 per day, which is $3,650 per year. Dividends are reinvested. Here's what the projections show. After the first year, the portfolio is worth $3,650. After 10 years, it grows to about $80,884. After 20 years, it reaches roughly $452,350, and after 30 years, it ends up at about $2,133,710. More than $2 million, built using the same daily investment. Income stays intentionally small. By year 30, this portfolio generates about $1,888 per year in dividends, or roughly $157 per month. That income is almost irrelevant compared to the size of the portfolio, and that's by design. Nearly all of the value comes from capital appreciation. When you break it down, about $2,024,210 of the final value is value added beyond your contributions. Roughly $2,003,351 comes from price growth, while only about $20,859 comes from dividend reinvestment.
Most people invest without ever stopping to ask one basic question: what is this money supposed to do for me? They buy a fund, keep adding money, and assume everything will make sense later. But investing usually comes down to a very simple choice. Do you want to grow your money or live off your money? In this video, I'm breaking down what that choice really looks like over time. I'll show you how I compared several major Fidelity index funds, explain which one of them naturally lands in the middle between growth and income, and then compare it directly to SCHD, which is built specifically to produce income using the same $100,000 in both cases. Both approaches can turn $100,000 into a multi-million-dollar portfolio. Both can eventually pay an income above the average American salary. But in the end, I'll show you how one path can grow that $100,000 into roughly $6 million, while the other builds a portfolio that pays over $28,000 per month in dividend income. Before comparing anything to SCHD, I wanted to make sure I wasn't cherry-picking a Fidelity fund just because it was popular. Fidelity has several major index funds, and they don't all behave the same way. If the goal is to understand where income and growth actually meet, you have to filter them intentionally. So I looked at 5 well-known Fidelity index funds, not to rank them and not to crown a winner, but to understand what role each one plays and what kind of investor each one naturally fits. This step matters because skipping it often leads people to the wrong conclusions. Fidelity 500 Index Fund, FXAIX, is the classic growth engine. It owns the biggest companies in the US, and its job is simple: track the market and grow over time. It does pay a dividend, but income clearly isn't the priority. Most of what you're hoping for here comes from price growth. Fidelity Zero Total Market Index Fund, FZROX, takes a different approach. Instead of focusing on large companies, it owns a little bit of everything. That broad exposure is powerful, but it also means income is more of a byproduct than a goal. You're owning the market, not designating a cash flow strategy. Fidelity Zero Large Cap Index Fund, FNCMX, looks different on paper, but in practice it behaves very similarly to FXAIX. Strong growth, modest income, and returns driven mostly by what the market does. Fidelity Nasdaq Composite Index Fund, FNCMX, turns growth up another notch. This is where innovation and price appreciation take center stage. But income here is almost an afterthought, and consistency can disappear when markets get rough. Then there's Fidelity US Sustainability Index Fund, FITLX. This is where things change. FITLX still tracks the market, but it tilts towards companies that generate real cash, manage their businesses conservatively, and consistently return money to shareholders. The dividend yield is real, the dividend growth is meaningfully stronger, and price growth stays competitive. That combination matters. FITLX isn't trying to maximize income, and it isn't chasing pure growth either. It deliberately sits in the middle, and that's exactly why it makes sense to compare it to SCHD. But before putting those two side by side, it's important to understand what FITLX is actually built to do, not on paper, but in practice. FITLX doesn't really make sense until you stop thinking about labels and start thinking about behavior. Ignore the word sustainability for a moment, because what this fund is actually doing is pretty simple. The fund becomes much clearer when you look at what it actually owns. This isn't a high-yield fund, and it isn't a speculative growth fund either. It's built around large, profitable companies that generate real cash and still have room to grow. Start with the sector exposure. Nearly 40% of the portfolio is in technology, with another 11.7% in communication services and 11.2% in financials. Those are growth-oriented sectors, and they explain why FITLX has been able to deliver strong price appreciation over time. But this isn't growth at any cost. You also see meaningful exposure to healthcare, consumer cyclical, and industrials, which adds balance and durability. Now look at the companies themselves. The top holdings include Microsoft, Alphabet, Nvidia, Visa, MasterCard, Eli Lilly, and Tesla. These are businesses with strong margins, pricing power, and consistent free cash flow. They're not dependent on cheap money or perfect market conditions to survive. They make money first, then decide how to allocate it. That shows up directly in the dividend behavior. FITLX's current dividend yield is modest, around 1.1%, which tells you income isn't the upfront focus. But the dividend growth rate, at roughly 15% annually, reflects the type of companies inside the fund. These are businesses that can increase payouts because their cash flow is expanding, not because they're stretching to meet a yield target. At the same time, growth isn't sacrificed. With average annual share price appreciation north of 13% since inception, FITLX keeps pace with the broader market. That's the key point. You're not giving up growth just to get some income. Growth still drives most of the return while dividends compound in the background. This structure creates flexibility across market environments. When markets move higher, growth-heavy sectors like technology and communication services pull the portfolio forward. When markets slow down, rising dividends and cash-rich balance sheets help stabilize the experience. That's what FITLX is built to do, let growth and income rise together. SCHD takes the opposite approach. SCHD is straightforward once you look at what it owns. It isn't trying to balance multiple goals, it's built with one clear priority: dependable income. Everything else is secondary, and that focus is intentional. Start with the sector mix. Roughly 55% of the portfolio sits in defensive, cash-generating sectors, which include energy at 18.9%, healthcare at 18.1%, and consumer defensive at 18.1%. These are industries known for stable demand and predictable earnings, not rapid expansion. Technology, by comparison, makes up only about 10% of the fund, which immediately tells you growth is not the priority. The holdings reinforce that idea. SCHD's top positions include Merck, Cisco, Amgen, AbbVie, Coca-Cola, PepsiCo, Chevron, and ConocoPhillips. These are mature businesses with established market positions and consistent free cash flow. They're not reinvesting every dollar to chase growth. They're built to return cash to shareholders. That design shows up directly in the income. SCHD's dividend yield sits around 3.75%, more than 3 times higher than FITLX. That means income is meaningful from day one, not something you wait decades to feel. Dividend growth is also strong, roughly 10.6%, and it's steady and predictable. This structure explains the trade-off. With fewer high-growth sectors and fewer reinvestment-heavy companies, SCHD naturally gives up some long-term price appreciation. Average share price growth has been closer to 7.8%, well below growth-oriented index funds. That's not a flaw, it's the cost of prioritizing income today. What you get in return is consistency. When markets fluctuate, dividends continue. When prices stall, cash flow doesn't disappear. For many investors, that visible income reduces emotional pressure and makes it easier to stay invested through uncertainty. Over time, this creates a very different experience from a balanced or growth-leaning fund. SCHD rewards you earlier through cash flow while accepting slower portfolio growth. FITLX delays gratification but compounds faster later. Both approaches work, but they solve different problems. FITLX uses growth to build income later. SCHD uses income to define the strategy from the start. In a few minutes, you'll see how the same $100,000 can grow into millions in two very different ways. One focused on total value and the other on monthly income over $28,000. On paper, that's a structural difference. In real life, it changes how investors experience risk. When people talk about risk, they usually point to charts, percentages, and market crashes. But for most investors, the real risk isn't what the market does, it's what they do in response to it. Volatility is uncomfortable because it creates doubt. When an account value swings up and down, it constantly asks you to make emotional decisions. Should you stay in? Should you adjust? Should you stop altogether? Even when the long-term math is sound, that emotional pressure can push people into bad timing. Income changes that experience. With an income-focused fund like SCHD, dividends continue even when prices don't cooperate. A yield near 3.8% means cash flow shows up regardless of short-term market moves. That visible income acts as confirmation that the strategy is working, which makes it easier for many investors to stay patient. Growth-oriented strategies require a different mindset. With FITLX, most of the return comes from price appreciation, especially early on. Income exists, but at around 1.1%. It doesn't soften drawdowns much in real time. For investors who are comfortable with uncertainty, that's fine. For others, it becomes exhausting. Neither response is a flaw. They're human reactions. The problem starts when someone chooses a strategy that doesn't match how they actually behave. A portfolio that looks perfect on paper can fall apart if it constantly tempts you to intervene. This is why behavior often matters more than expected returns. A strategy you can stick with usually beats a better strategy you abandon at the wrong time. Staying invested through downturns, continuing to reinvest, and avoiding emotional decisions compound results in ways no spreadsheet can fully capture. FITLX and SCHD work for different people. One asks you to tolerate more movement for long-term expansion, while the other reduces emotional friction by paying you along the way. Up to this point, we've talked about philosophy, behavior, and how these funds feel to own. But there's another layer that shapes long-term results, and it often gets overlooked because it isn't exciting: taxes and efficiency. Taxes don't change returns on paper, but they change how much of those returns actually get to compound. In a taxable account, dividends are usually taxed the year you receive them. With SCHD, a dividend yield of around 3.8% means a meaningful portion of returns shows up as taxable income every year. If you're paying even 20 to 25% in combined taxes, that's cash leaving the portfolio annually instead of compounding. FITLX behaves differently. With a dividend yield closer to 1.1%, far less of the return is taxed each year. Most of the growth comes from price appreciation, which is typically deferred until you sell. That gives compounding more room to work uninterrupted over long periods. Where this really starts to matter is in account type. In tax-advantaged accounts like IRAs or 401ks, this difference largely disappears. Dividends from SCHD can be reinvested without immediate tax drag, making income strategies far more efficient. In taxable accounts, the gap becomes more noticeable over decades. This doesn't make one fund better than the other. It means the same fund can produce very different outcomes depending on where it's being held. For this video, we're assuming the investment is held inside a tax-advantaged account like a traditional IRA or Roth IRA where dividends can be reinvested without immediate tax impact. That levels the playing field and lets both FITLX and SCHD compound without annual tax drag. With taxes neutralized, the only thing left is performance over time. Now projections finally make sense, not as promises or guarantees, but as a way to visualize how each strategy can realistically compound when the same $100,000 is left alone. Let's start with FITLX. The starting dividend yield is about 1.1%, so income isn't the headline early on, but dividend growth around 15.42% changes the trajectory over time. Add average share price appreciation of roughly 13.38%, and you get a growth-driven engine with income acting as an accelerator rather than the main fuel. Based on these numbers, the projections show that a $100,000 investment in FITLX would be expected to grow to about $114,477 after 1 year. Over longer periods, the portfolio is projected to reach roughly $390,144 after 10 years, $1,558,441 after 20 years, and approximately $6,407,091 after 30 years. At that point, annual dividend income is projected to be around $109,840, which would translate to roughly $9,153 per month. Of the total $6,307,091 added over the original investment, about $5,574,945 would come from capital appreciation, while approximately $732,147 would come from reinvested dividends. Now compare that to SCHD. The starting dividend yield is much higher at around 3.82%, with the dividend growth rate of 10.61% and the average price appreciation closer to 7.82%. Income drives results much earlier. Based on these metrics, after 1 year, the portfolio is projected to reach $111,640, then $314,954 after 10 years, $1,120,352 after 20 years, and roughly $4,667,611 after 30 years. Annual dividends at that point are estimated at around $340,515, or about $28,376 per month. Of the $4,567,611 added, roughly $2,377,866 comes from capital appreciation, and $2,189,745 from dividend reinvestment. When you line the projections up, the difference becomes clear. Over 30 years, FITLX is projected to reach about $6.4 million, while SCHD is projected to reach about $4.67 million. That means FITLX produces roughly $1.7 million more in total portfolio value over the same time period. But income tells the opposite story. After 30 years, SCHD is projected to generate about $28,376 per month in dividends, compared to roughly $9,153 per month from FITLX. That's about $19,200 more per month in income from SCHD, or over $230,000 more per year. So the trade-off is clear in real numbers. FITLX is projected to give you significantly more net worth. SCHD is projected to give you significantly more cash flow. So if your priority is maximum portfolio value, the winner is FITLX. If your priority is maximum income, the winner is SCHD. These numbers are incredible, no doubt, but not everyone has $100,000 to start with. If you invested just $10 a day, would you want income or growth? It sounds like a small decision, almost boring, but over time, that single choice shapes how your money behaves, how patient you have to be, and what you eventually get back. Most people make that choice without ever realizing they made it. In this video, I'm going to run a simple experiment using the same money, the same ETFs, and the same timeline, changing only one thing: whether the portfolio leans toward income or growth. We'll break down how each approach works, build one adjustable portfolio, and then turn the dial in both directions. And by the end, I'll show you how a growth-focused portfolio can add an extra $740,000 to your total value, while a dividend-focused portfolio can generate over $7,500 a month in income, all from the same $10 a day investment. The reason those two outcomes are possible comes down to one simple idea. Once your money is invested, there's really only two things it can do. It can stay inside and keep working, or it can start coming back to you as cash. Everything else people talk about is just a variation of those two behaviors. When money stays inside, it's being used to grow the business it's invested in. New products, expansion, efficiency, all of that gets funded internally. Nothing shows up in your account, but more value is being built behind the scenes. Over time, that value usually shows up as a higher share price. The progress is real, but it's quiet. You don't feel it day to day. When money comes back to you, it's doing the opposite. Instead of being reused inside the business, a portion of it is sent out to investors regularly. That cash is tangible. You can spend it, save it, or reinvest it somewhere else. It feels reassuring because something is happening right now, not someday later. Here's the trade-off most people don't fully think through. Money can't be in two places at once. Every dollar that comes out is a dollar that isn't compounding inside anymore. That doesn't make one behavior right and the other wrong, but it does mean they lead to very different outcomes over long periods of time. This is why the decision feels so personal. Some people value seeing progress. Others value building momentum. And most people actually want a bit of both, even if they don't realize it yet. Before we put labels on any of this, you're not choosing an ETF. You're choosing how your money moves while time multiplies it. People usually don't start with the behavior. They start with the labels. Growth investing, dividend investing, those words get thrown around a lot, but they're really just names for the two behaviors we've been talking about. When money mostly stays inside and compounds, that's what people call growth investing. It's not about chasing hype or taking wild risks. At its core, it's simply choosing to let your money remain fully at work. The goal is not to get paid today. The goal is to make the pile itself grow as large as possible over time. You don't see much along the way, which is why it can feel uncomfortable, but the expectation is that patience gets rewarded later through higher prices. Dividend investing puts the emphasis somewhere else. Instead of asking the money to stay inside forever, you're asking it to start paying you back along the way. Part of the return shows up as regular cash. That cash can be reinvested, used to cover expenses, or just held. The trade-off is that because some money is leaving the system, the pile usually grows more slowly. What matters here isn't the label, it's the job you're assigning to each dollar. Is it there to maximize future size, or is it there to create cash flow you can actually use, maybe today or maybe later down the years? This is where people often get stuck, because the labels make it feel like you're choosing an identity. Like, once you pick one, you're locked in. But that's not how this really works. These aren't opposing teams, they're just two ways of directing effort. And once you see them that way, the question stops being which one is better and starts becoming something far more practical. How should these two behaviors work together for you right now? This is where most explanations start to drift off track because they treat ETFs like strategies. They're not. An ETF is just a container.
What matters isn't the label on the box, but what the box is designed to do with the money inside it. Some ETFs are built to keep most of the money working internally. The companies inside them reinvest profits instead of sending cash out. The goal is simple: grow the value of what you own over time. Other ETFs are built to send a meaningful portion of that money back to you on a regular basis. The goal there isn't maximum growth, it's consistent cash flow. That's it. There's nothing mystical going on here. ETFs just lean in different directions based on what the underlying companies do with their profits. Some keep capital inside longer, others return it sooner. That difference alone tells you almost everything you need to know. Not whether an ETF is good or bad, but what kind of behavior it encourages. Does it prioritize compounding, or does it prioritize income? This also explains why the same ETF can make sense in very different situations. The ETF itself doesn't change. What changes is how much weight it carries and what role it plays alongside the others you hold. So instead of thinking in terms of growth ETFs versus dividend ETFs as separate worlds, it's more useful to think in terms of tools. Each one nudges your money in a slightly different direction. Some push harder toward future size. Others pull value forward into the present. How you combine them determines what your portfolio actually does. If we look at ETFs that lean toward keeping money inside, a few patterns show up immediately. The dividends are small. Dividend growth exists, but it's not the focus. Most of the return shows up somewhere less obvious, in the price itself. Take VGT first. Its dividend yield sits around 0.4%, and dividend growth is modest at about 1.76%. That tells you right away this ETF isn't designed to pay you income. Almost everything it earns stays inside. The payoff for that shows up in price appreciation, which has averaged roughly 22.27%. This is money being recycled back into growth over and over again. SCHD behaves in a similar way, but across a broader set of large companies. The dividend yield is even lower, at about 0.36%, with dividend growth closer to 3.79%. Again, not much cash coming out. What you're getting instead is price growth, averaging about 18.14%. It's the same behavior, just spread across more of the markets instead of one sector. QQQ adds an interesting wrinkle. The yield is still low at about 0.45%, so it clearly leans toward growth, but dividend growth is noticeably higher at roughly 9.73%. Even so, the real engine is still price appreciation, averaging around 19.52%. This is growth that occasionally throws off a little cash, but never at the expense of momentum. The pattern is consistent. Very little money comes out. Most of the return stays inside. And over time, that shows up as faster growth in the value of what you own, not regular income hitting your account. When ETFs lean toward sending money back to you, the pattern flips. Cash flow becomes the priority. Growth doesn't disappear, but it takes a back seat to consistency and reliability. Start with SCHD. Its dividend yield sits about 3.73%, and dividend growth has averaged about 10.61%. That combination tells you exactly what it's built for: regular income that still grows over time. Price appreciation is there, averaging roughly 8.78%, but it's not trying to be the main driver. SPYD leans even harder into income. The yield is higher, around 4.44%, and dividend growth has been strong at roughly 19.44%. That income focus shows up in slower price appreciation, averaging about 4.68%. More cash comes out, so less stays inside to compound. JEPI pushes this idea to the extreme. With a yield around 7.41% and dividend growth near 7.88%, it's designed to generate income first and foremost. Price appreciation has averaged only about 0.79%, which isn't a flaw, it's a trade-off. Growth is intentionally sacrificed to maximize cash flow today. The difference compared to growth-leaning ETFs is immediate. Instead of waiting for progress to show up in price, income arrives on a regular schedule. It's visible. It's tangible. This is the defining feature of dividend-leaning ETFs. In a couple of minutes, I'll show you how this same portfolio can be adjusted toward growth or toward income. And by the end, you'll see how a growth-focused version adds an extra $740,000 in value, while a dividend-focused version generates over $7,500 a month in income, all from the same $10 a day investment. Before that, let's look at how one portfolio can do both at the same time. By this point, the picture should feel clearer. Growth and dividends aren't rival strategies fighting for dominance. There are two behaviors that can exist inside the same system. Once you strip away the labels, the conflict disappears. One behavior keeps money inside and compounds faster. The other pulls money out and turns it into cash flow. Neither one cancels the other out. They simply pull in different directions. This is where a lot of people overcomplicate things. They think choosing growth means abandoning income, or choosing income means giving up growth forever. But that's not how portfolios actually work in practice. There's no rule saying money has to do only one thing. Some of it can stay inside and push for long-term growth. Some of it can come out and provide cash along the way. The real decision isn't picking a side. It's deciding how much emphasis each behavior gets at the same time. Think of it like a dial, not a switch. You're not turning growth off to turn income on. You're adjusting the balance between the two. Turn the dial toward growth, and most of the money stays inside. Turn it toward income, and more of that money starts flowing back to you. Now the question is, how should this dial be set up for you right now, given what you actually want your money to do? With that dial in mind, this is where everything finally comes together. Instead of building two separate portfolios, it makes more sense to think in terms of one adjustable portfolio. The ETFs don't change. What changes is how much weight each behavior gets inside the same structure. That's it. This approach removes a lot of unnecessary pressure. You're not committing to an identity or locking yourself into a single path forever. You're deciding how you want your money to behave right now, with the understanding that the balance can always shift later. So, imagine one portfolio built from the same growth-leaning ETFs and the same dividend-leaning ETFs we just talked about. No new tools, no extra complexity, just different emphasis. When the dial leans toward growth, more weight goes to the ETFs that keep money inside and push for price appreciation. Dividend ETFs are still there, but they play a supporting role. When the dial leans toward income, the balance shifts. Dividend ETFs take the lead, and growth ETFs move into the background to keep long-term momentum alive. This framework is what keeps things simple. You're not starting over, you're not rebuilding from scratch, you're just adjusting how much of your portfolio is focused on future size versus present cash flow. And with that structure in place, we can finally look at what those two dial positions actually look like in practice. Start by turning the dial toward growth. This is what the same portfolio looks like when future size is the priority. In this position, 75% of the portfolio is allocated to growth ETFs and 25% to dividend ETFs. On the growth side, VGT, SCHD, and QQQ are each weighted at 25% of the portfolio, making up the majority of the structure. These are the ETFs that dominate how the portfolio behaves. The remaining 25% is spread across SCHD, SPYD, and JEPI, each at about 8.3%. In this setup, they aren't meant to drive income. They're there to add balance and a small amount of cash flow without slowing the growth engine too much. When you blend everything together, the portfolio reflects that emphasis clearly. The blended dividend yield comes out to about 1.6%, which tells you very little cash is being pulled out along the way. At the same time, average share price appreciation across the portfolio lands around 16.17%, meaning most of the return is happening through rising prices, not income. That's the trade-off by design. This setup isn't built to feel rewarding month to month. It's built to let as much money as possible stay inside and compound over time. This is what a growth-tilted position looks like in practice. Now turn the dial the other way. This is the exact same portfolio built from the same ETFs, but tuned for income instead of maximum growth. In this position, 75% of the portfolio is allocated to dividend-leaning ETFs. SCHD, SPYD, and JEPI are each weighted at 25% of the portfolio, and together they drive how the portfolio behaves. The remaining 25% is allocated to growth ETFs, with VGT at 8.34% and SCHG and QQQ at about 8.33% each. Their role here isn't to lead, it's to keep long-term growth alive in the background. When everything is blended together, the income focus is clear. The portfolio produces a dividend yield of about 4%, and just as important, that income isn't static. Average dividend growth across the portfolio comes in around 10.76%, meaning the cash flow is designed to grow over time, not stay flat. That shift shows up on the growth side as well. Average share price appreciation drops to about 8.56%. Growth hasn't disappeared, but it's slower by design. This setup trades speed for reliability. Instead of waiting for progress to show up in price, value shows up as growing income along the way. This is what the income-tilted position looks like in practice. Same portfolio, same tools, just a dial turned toward long-term value into usable cash along the way. Now we can finally put real numbers behind everything we've been talking about. Same ETFs, same structure, same daily effort. The only thing that changes is how the dial is set. In both cases, the setup is identical. $10 invested every day, no starting lump sum, dividends fully reinvested, 30 years. Start with the dial turned toward growth. With a daily contribution of $10 by the end of year one, you would have invested $3,650. From that same starting point, the long-term picture begins to separate. After 10 years, the portfolio is projected at about $82,105. By 20 years, it's valued at roughly $460,610. And after 30 years, the portfolio ends up around $2,169,003. What's driving that result becomes clear when you break it down. Over the full 30-year period, the total value added is about $2,059,503. Of that, roughly $2,035,545 comes from capital appreciation, while only $23,958 comes from dividends being reinvested. Almost all of the growth comes from money staying inside and compounding. Income does exist at that point, but it's modest by design. After 30 years, the portfolio is projected to generate about $1,821 per year in dividends, which works out to roughly $152 per month. This setup was never meant to pay much along the way. It was built to maximize long-term value. Now look at the same daily contribution with the dial turned toward income. Again, by the end of year one, you would have invested the same $3,650. After 10 years, the income-focused portfolio is projected at about $67,630. At 20 years, it's valued at roughly $323,065, and after 30 years, it ends up around $1,426,747. The breakdown tells a very different story. Over the 30-year period, the total value added comes to about $1,317,247. Of that, only $739,407 comes from capital appreciation, while a much larger $577,840 comes from dividends being reinvested along the way. That income focus becomes unmistakable by year 30. The portfolio is projected to produce about $92,035 per year in dividends, which comes out to roughly $7,670 per month. A significant portion of the portfolio's final value comes from cash being paid out and reinvested over time, not from rising prices alone. Same daily contribution, same time horizon, two very different outcomes. After 30 years, the difference between the two approaches is clear. The growth-tilted portfolio ends up valued at about $2.17 million. The income-tilted portfolio ends up around $1.43 million. That's a gap of roughly $740,000 in total portfolio value created by the same daily contribution over the same time period. But the income side tells an equally important story. At year 30, the growth-tilted portfolio produces about $1,821 per year in dividends, or roughly $152 per month, while the income-tilted portfolio, by contrast, produces about $92,035 per year, or roughly $7,670 per month. That's a difference of more than $90,000 per year in income. So who wins? Well, if the goal is maximum net worth, growth wins. Letting more money stay inside and compound for decades creates a much larger final pile. If the goal is cash flow you can actually live on, then income wins. The income-tilted portfolio sacrifices long-term size in exchange for financial flexibility much sooner. This isn't a case of one strategy being smarter than the other, it's a case of priorities. One approach maximizes future value, the other converts value into usable cash. If you woke up tomorrow and suddenly had $500,000 sitting in your account, your first reaction probably wouldn't be confidence. It would be hesitation, maybe even a little anxiety. Most people either rush into something, try to outsmart the market, or spread the money around with no real plan and hope it works out. John felt the same tension. Not because $500,000 isn't a lot of money, it is, but because big money magnifies small mistakes. So instead of guessing or overthinking, John makes one choice. He takes the $500,000, puts it into the top 5 best Fidelity index funds, and then does the hardest thing in investing: nothing. In this video, I'm going to walk through what that looks like for John, how each type of fund grows over time, how dividends start small then stack on top of themselves, and why compounding feels slow at first before it starts doing most of the work for you. Along the way, I'll show you which fund ends up paying John over $45,000 a month, and by the end, I'll show you the one fund that can potentially turn John's $500,000 into a portfolio worth more than $47 million. Before we even look at the first fund, though, there's one thing John has to understand, because without it, none of the numbers later will make any sense. This is why long-term investing works in the first place, and that is compounding. Most people hear the word compounding and think it's just a formula. In reality, it's more like momentum. At the beginning, nothing seems to happen. Progress feels slow, sometimes even pointless. That's exactly why so many people quit too early. Compounding works because every year you're not just earning on your original money, you're earning on everything it has already grown into. Early on, the base is small, so the results look unimpressive, but as the portfolio grows, the same percentage starts working on a much larger number. That's when growth feels like it accelerates, even though the rules never changed. Here's a simple way to see it. Imagine starting with $100,000 and growing it at 10% per year. In year 1, you earn $10,000, bringing the balance to $110,000. In year 2, the same 10% now applies to $110,000, and that adds $11,000, pushing the portfolio to $121,000. In year 3, 10% adds $12,100, bringing the total to $133,100. Nothing changed except the base getting bigger. Each year, the same percentage produces more dollars because previous gains stay invested. That's compounding in its simplest form, and it's the engine behind every long-term result you're about to see. Dividends add another layer. A small payout doesn't feel life-changing, but when dividends are reinvested, they buy more shares, which then produce their own growth and future dividends. Over time, those small additions compound alongside price appreciation. Index funds are built for this exact process. When companies grow, they naturally become a bigger part of the index. When others fall behind, their influence shrinks. There's no need to constantly make decisions or guess which stock is next. You stay aligned with long-term winners as the market evolves. On top of that, index funds have super low fees. That's exactly what John is looking for. Instead of trying to pick winners, he owns the entire system through index funds and lets time do the heavy lifting. With that in mind, let's start at the bottom of the list and work our way up, beginning with number 5, the Fidelity Mid-Cap Index Fund, or FSMDX for short. This index fund sits right in the middle of the market. It invests in mid-sized U.S. companies that are past the risky startup phase but not yet massive corporations. These are businesses that are already established, making real money, and still have room to grow. That balance is what makes mid-cap investing appealing for long-term growth without taking extreme risks. FSMDX holds 815 different companies, which gives it strong diversification right out of the gate. What really stands out is how evenly spread that exposure is. The top 10 holdings make up just over 6% of the entire fund. That means no single company has the power to drag the whole portfolio down or push it up on its own. Performance comes from the broader strength of the mid-cap market, not from betting on a few big names. The sector mix is also well-balanced across the economy. Industrials account for 17.17%, technology 15.8%, financials 13.54%, consumer cyclical 12.02%, healthcare 9.88%, and real estate at 7.16%. The rest is spread across utilities, energy, communication services, and basic materials. This kind of balance helps reduce risk across market cycles because different sectors tend to perform well at different times. Looking at performance, FSMDX shows steady long-term growth with normal ups and downs along the way. Over the last year, the fund gained 9.77%. Over 5 years, total growth was 38.78%. Over 10 years, the fund delivered a total return of 129.35%. These numbers reflect its role as a long-term growth fund, not something designed for short-term trading. Another major advantage is cost. FSMDX has an expense ratio of just 0.03%. That may sound small, but over the decades, it matters. Less money going to fees means more money staying invested and compounding year after year. From a risk standpoint, the fund stays disciplined. Portfolio turnover is 15%, which reflects moderate rebalancing consistent with an index fund that helps limit unnecessary trading costs. On the technical side, the long-term trend is still healthy. The 10-day simple moving average is 37.52, and the current price is 0.23% below that level, which simply points to normal short-term consolidation. At the same time, the fund is 1.23% above the 50-day moving average of 36.98 and 6.04% above the 200-day moving average of 35.3. In plain terms, there's some short-term noise, but the bigger trend is still clearly pointing upward. Now let's look at the dividend performance.
FSMDX has a current dividend yield of 1.09%. Dividend growth has been weak, with a 5-year dividend growth rate of negative 8.45%, which confirms that income is not the fund's main priority. Instead, most returns come from price movement, supported by an average annual share price appreciation of 8.56%. This makes FSMDX a growth-oriented fund where dividends play only a small supporting role. Now let's look at what this means for John over time. If John invests $500,000 into FSMDX with no additional contributions, the projections show the portfolio valued at $548,250 after 1 year. Looking out further, it's projected at $1,194,710 after 10 years. At the 20-year mark, the portfolio is estimated to reach $2,737,261, and by year 30, it's projected to be valued at $6,230,671. Dividend income remains modest even over long periods. In year 30, annual dividends are projected at $281, which works out to about $23 per month. Across the full 30-year timeline, total value added is projected at $5,730,671, with $5,676,194 coming from capital appreciation and $54,477 from dividend reinvestment. Now let's move up the list to number 4, the Fidelity 500 Index Fund with the ticker symbol FXAIX. This index fund tracks the performance of the S&P 500, giving investors exposure to the largest and most established U.S. companies. These businesses represent the core of the U.S. economy, including global leaders across technology, finance, healthcare, and consumer sectors. FXAIX is designed for long-term investors who want steady growth with broad diversification and low costs. FXAIX holds 507 companies, which provides solid diversification while still concentrating on market leaders. The top 10 holdings account for 40.1% of the portfolio, which means performance is meaningfully influenced by the largest companies. That's not a flaw, it's how market cap-weighted indexes work. The most valuable and successful businesses naturally carry more weight. Sector exposure reflects that structure. Technology makes up 36.87% of the portfolio, followed by financials at 12.58%, consumer cyclical at 10.66%, communication services at 10.38%, and healthcare at 8.96%. Industrials account for 7.4%, with smaller allocations to consumer defensive, energy, utilities, real estate, and basic materials. This mix allows FXAIX to benefit strongly during economic expansion while still maintaining exposure across the broader market. Looking at performance, FXAIX has delivered strong and consistent long-term growth. Over the last year, the fund gained 15.7%. Over 5 years, total growth was 87.66%. Over the longer 10-year period, FXAIX delivered a total return of 232.62%, clearly highlighting the strength of large-cap U.S. equities when held through full market cycles. Another major advantage of FXAIX is cost efficiency. The fund has an extremely low expense ratio of just 0.02%, meaning nearly all of the fund's returns stay in the investor's pocket. FXAIX follows a very stable long-term strategy with minimal trading activity. The turnover ratio is just 3%, which means the fund rarely makes changes. This low turnover helps reduce costs and keeps the strategy focused on long-term market growth rather than short-term moves. FXAIX is trading above its key moving averages, which signals strong momentum. Dividend income plays a supporting role here. FXAIX has a current dividend yield of 1.1%, and dividend growth has been steady with a 5-year dividend growth rate of 4.93%. Average annual share price appreciation sits at 12.73%, which explains why capital growth does most of the heavy lifting. Now let's look at how this plays out for John.
With an initial investment of $500,000, the projections show the portfolio valued at $569,150 after 1 year. Looking out 10 years, it's projected to reach $1,776,097. At the 20-year mark, the portfolio is estimated at $6,070,882. And after 30 years, it's projected to be valued at $20,398,411. Dividend income becomes more meaningful over time. In year 30, annual dividends are projected at $18,869, which works out to about $1,572 per month. Across the full 30-year period, total value added is projected at $19,898,411, with $19,565,670 coming from capital appreciation and $332,741 from dividend reinvestment. These numbers are great, but there are even better options to come as John moves up the ladder. In a couple of minutes, I'll show you which fund ends up paying John over $45,000 a month, and by the end, I'll show you one fund that can potentially turn John's $500,000 into a portfolio worth more than $47 million. But first, let's look at the third index fund on John's list, the Fidelity Zero Total Market Index Fund, also known as FZROX. This fund is designed to track the entire U.S. stock market in one single fund. It includes large, mid, small, and micro-cap companies, which makes it one of the most complete, own-everything options available. Instead of betting on a specific segment of the market, FZROX holds 2,553 companies, which gives it extremely broad diversification. Even with thousands of stocks inside, concentration is still reasonable. The top 10 holdings make up 35.25% of the portfolio. Large companies still matter, but performance isn't dependent on just a few names. Risk is spread across a wide base. Sector exposure closely mirrors the U.S. economy itself. Technology leads at 35.09%, followed by financials at 12.76%, consumer cyclical at 10.65%, communication services at 9.66%, healthcare at 9.41%, and industrials at 8.64%. Smaller allocations go to energy, real estate, utilities, consumer defensive, and basic materials. This balance allows the fund to benefit from long-term economic growth without leaning too heavily on any single sector. From a performance standpoint, FZROX has delivered strong and consistent results. Over the last year, the fund gained 15.53%. Over 5 years, total growth reached 79.28%. Since its inception, the fund has shown a total return of 135.46%. One of the biggest advantages here is cost, or more accurately, the lack of it. FZROX has an expense ratio of 0%. That means none of your returns are lost to management fees. Over long periods of time, keeping every dollar invested gives compounding more room to work, even compared to funds that already have very low costs. The strategy itself stays hands-off. The turnover ratio is just 3%, which means the fund rarely trades. That keeps costs down and allows returns to compound efficiently without unnecessary movement. FZROX is also trading above all key moving averages, which points to steady upward momentum. Dividends add another layer. FZROX has a current dividend yield of 1.01%, and dividend growth has been solid, with a 5-year dividend growth rate of 7.19%. On the growth side, the fund benefits from strong price movement, supported by an average annual share price appreciation of 14.42%. Together, that creates a balance where both growth and dividends contribute meaningfully over time. Now let's look at how the projections play out for John with this fund. Starting with an initial investment of $500,000, the projections show the portfolio valued at $577,150 after 1 year. Looking ahead 10 years, it's projected to reach $2,050,615. At the 20-year mark, the portfolio is estimated at $8,130,124, and by year 30, it's projected to be valued at $31,721,312. Dividend income becomes more noticeable over time. In year 30, annual dividends are projected at $31,736, which works out to about $2,645 per month. Across the full 30-year period, total value added is projected at $31,221,312, with $30,774,872 coming from capital appreciation and $446,440 from dividend reinvestment. FZROX works well for investors who want maximum diversification, zero fees, and a simple way to capture the full power of the U.S. stock market. It removes the need to choose sides and lets the entire system work on your behalf. And from here, the next fund starts to tilt the story in a slightly different direction, keeping broad exposure, but adding another layer that changes how returns show up over time. Taking up the number 2 spot is the Fidelity U.S. Sustainability Index Fund, or FITLX for short. This index fund invests in large U.S. companies that meet specific environmental, social, and governance (ESG) criteria. In simple terms, it focuses on businesses that are not only profitable but also operate with long-term sustainability in mind. The goal isn't to sacrifice returns for principles, but to align both in a single strategy. FITLX holds 276 companies, which is fewer than the total market fund, but still provides solid diversification. What stands out here is concentration. The top 10 holdings account for 51.46% of the portfolio, which means performance is more heavily influenced by large, dominant companies. Much of that influence comes from technology and communication services, which help explain both the growth potential and the added volatility compared to broader funds. Sector allocation reflects this focus. Technology accounts for 39.23% of the portfolio, followed by communication services at 11.73%, financials at 11.19%, consumer cyclical at 9.99%, and healthcare at 9.76%. Industrials make up 7.48%, while smaller allocations are spread across consumer defensive, real estate, basic materials, energy, and utilities. This mix tilts the fund toward growth-oriented sectors while still maintaining exposure across the broader economy. Performance has been strong across all time frames. Over the last year, FITLX gained 16.57%, showing solid recent momentum. Over 5 years, the fund delivered a total return of 93.11%. Looking at the fund's full available history, total growth stands at 209.44%. These figures show that a sustainability-focused strategy has still captured strong long-term market growth. The fund's expense ratio is 0.11%, which is slightly higher than ultra-low-cost index funds, but still very competitive for a sustainability-focused strategy. Over long investment periods, this cost remains reasonable relative to the growth achieved. FITLX has a higher turnover compared to broad market index funds, with a turnover ratio of 9%. This reflects periodic rebalancing based on sustainability criteria rather than frequent trading. While this adds a bit more movement than traditional index funds, it still remains firmly long-term in nature. FITLX is trading above all major moving averages, which signals solid momentum. Dividends are where this fund really starts to separate itself. FITLX has a current dividend yield of 1.1%, and dividend growth has been unusually strong with a 5-year dividend growth rate of 15.42%. At the same time, average annual share price appreciation sits at 13.45%. Now let's look at how the projections play out for John with this index fund. Starting with $500,000, the model shows the portfolio sitting at $572,750 after the first year. As time does its thing, the value is projected to climb to $1,962,531 by year 10, and at the 20-year point, the portfolio is valued at $7,878,915. By year 30, it reaches $32,508,831. This is also where the income side really starts to show up for John. By year 30, annual dividends are projected at $545,680, which translates to roughly $45,473 each month. Over the full 30-year stretch, the total value added comes to $32,008,831, with $28,364,839 coming from price growth and $3,643,992 coming from reinvested dividends. Now let's move to the top index fund on the list that takes growth to another level. At number 1 on John's list, this is the Fidelity NASDAQ Composite Index Fund, also known as FNCMX. It tracks the NASDAQ Composite Index. This part of the market is built entirely around growth, technology, innovation, and companies that are shaping how the economy works tomorrow. Software, artificial intelligence, semiconductors, cloud computing, digital platforms, this fund lives right at the center of all of it. That focus comes with trade-offs. FNCMX tends to move faster than broader market funds. When markets are strong, it usually pulls ahead. However, when markets pull back, it often drops harder too. John knows going in that this fund isn't about stability. It's about long-term upside. FNCMX holds 2,914 companies, which sounds diversified at first glance, but concentration tells the real story. The top 10 holdings make up 60.36% of the portfolio. That means results are driven by a relatively small group of massive technology companies rather than being evenly spread across all holdings. The sector breakdown makes that clear. Technology alone accounts for 53.15% of the fund. Communication services make up 15.71%, consumer cyclical 13.89%, and healthcare at 5.39%. Financials, industrials, and the remaining sectors play much smaller roles. This structure explains why FNCMX has delivered powerful long-term growth and why volatility is part of the package. Performance numbers reflect that aggressive growth tilt. Over the last year, FNCMX gained 19.26%. Over 5 years, the fund delivered a total return of 86.26%. Over 10 years, returns reached 349.46%. These are the kinds of results that show up when growth cycles are strong, which it has been over the past decade or so. But they also come with sharper drawdowns when markets get stressed. Costs are higher than broad market index funds, but still reasonable for what you're getting. FNCMX has an expense ratio of 0.29%, which reflects its specialized exposure rather than inefficiency. Trading activity stays low. The turnover ratio is just 2%, meaning the fund sticks closely to its index and doesn't churn the portfolio. That helps keep costs and tax drag under control, even though price swings can be larger. FNCMX is trading well above its long-term trend levels. The price is 1.3% above the 10-day average, 1.77% above the 50-day average, and 14.2% above the 200-day average. Short-term volatility shows up, but the longer-term trend is still clearly pointing higher. Income isn't the goal here. FNCMX has a current dividend yield of 0.49%, and dividend growth has been negative with a 5-year dividend growth rate of negative 4.88%. That confirms what John already expects. This fund is almost entirely about price appreciation, and that growth has been strong, supported by an average annual share price appreciation of 16.34%. Now, let's look at what the projections show when John lets this index fund run with his $500,000. The model shows the portfolio valued at $584,200 after 1 year. Over time, the compounding accelerates. By year 10, the portfolio is projected at $2,313,322. At the 20-year mark, it reaches $10,525,966, and by year 30, the value expands to $47,821,177. Dividend income barely registers, even after decades. In year 30, annual dividends are projected at just $204 or about $17 per month. Over the full period, total value added comes to $47,321,177, with $47,293,036 coming from capital appreciation and only $28,141 from dividend reinvestment. This is a pure growth play. It's volatile, it's concentrated, and for John, it's the fund that shows what long-term compounding can look like when growth is pushed to the extreme. These numbers are incredible, no doubt. We all hear about the snowball effect and compounding. Invest, reinvest, and let time do the work. But there's one detail that usually gets skipped. For compounding to actually feel like it's working, you need around $100,000 behind it. That's when growth becomes noticeable and momentum shows up. The problem is obvious. Most people don't have $100,000. So the real question becomes, how small can you start and still get the dividend snowball moving? In this video, I'll show you why the beginning feels slow, why $100,000 is where everything changes, and the fastest way to reach that point using a portfolio built on clear, easy-to-follow criteria. You'll see how John takes two different paths to $100,000, one with the smallest upfront investment and the other with simple single-digit daily contributions. And by the end, I'll show you how both paths reach $100,000 quickly and ultimately build toward $1 million portfolio that pays over $5,000 a month in dividends. Now, to make all this work, you first need to understand why the beginning feels so slow. If you've ever tried investing, this part will feel familiar. You save some money, you invest it, you reinvest the dividends, then you wait. You check your account weeks later, maybe months, and it barely looks different. The balance hasn't moved much. The income feels almost invisible. That's usually the moment people start thinking compounding doesn't actually work, but nothing is broken. The problem isn't compounding, it's what we expect it to look like early on. See, at the beginning, the numbers are supposed to feel small. Say you invest $5,000 into a dividend portfolio earning 3%. That gives you $150 a year, not a month, a year. Even if those dividends grow fast, maybe 10 or 12%, the next year you're looking at around $165. That's a $15 difference over 12 months. You don't feel that. It doesn't change your behavior. You can reinvest every dollar and the math technically compounds, but you're stacking small numbers on top of small numbers. The system is doing exactly what it's supposed to do, it just doesn't have any weight yet. This is where most people get tripped up. Compounding is not driven by time alone, it's driven by scale. Time only amplifies what's already there. When the base is small, growth is small. When the base grows, growth accelerates automatically. John went through this phase too. His portfolio wasn't wrong, his strategy wasn't wrong, it just hadn't reached a size where the progress was easy to notice.
Nothing is broken in this phase. There's no mistake to fix. The only missing ingredient is mass. Until the portfolio reaches a size where gains can stack on top of meaningful gains, progress will feel slow. That's normal. Everyone goes through it. The people who succeed are not the ones who found a better strategy. So what actually makes compounding speed up? Well, it comes down to time, but not in the way most people think about it. Time doesn't add returns, it multiplies them. Suppose you start with $100,000 growing at 8% per year. After 10 years, it becomes about $216,000. After 20 years, it grows to roughly $466,000. That's steady progress, but it still doesn't feel dramatic. Now change one thing. Let it run for 10 more years. With no extra money and no better strategy, that same $100,000 grows to over $1 million. Those extra 10 years allow your money to earn on its own earnings. Early gains grow large enough to create much larger gains later. That's why the curve steepens near the end instead of the beginning. Growth rates amplify this effect. At 6%, $100,000 becomes about $574,000 after 30 years. At 8%, it reaches about $1 million. At 10%, it grows to roughly $1,745,000. A difference of 1% or 2% sounds small, but over decades, it completely changes the outcome. This is where people usually focus on the wrong part. The early years barely move the needle. The later years do most of the work. Compounding is backloaded. The biggest results show up at the end. This also explains why starting earlier often beats starting bigger. A smaller amount with more time can outperform a larger amount with less time. Time lowers how much you need up front and increases how much patience pays. When John started running the numbers this way, something stood out. No matter how the assumptions changed, the math kept circling the same idea. There was a point where time and growth finally became visible, not because the rules changed, but because the portfolio got big enough for them to work together. And when you let the math run long enough, one number keeps showing up. Around $100,000 is where compounding starts to feel different. Not because anything magical happens, but because the numbers finally get heavy enough to matter. Below that level, growth is real, but it's quiet. You don't feel it. A $25,000 portfolio earning 3% produces about $750 a year. That's easy to ignore. It doesn't change how you think. It doesn't change how you act. Now take that same portfolio at $100,000 at the same 3%, it's producing $3,000 a year. That's noticeable. More importantly, you can reinvest it meaningfully. Reinvesting $3,000 each year starts buying noticeable new income, and when dividends grow, the effect compounds faster. If that $3,000 grows at 10% annually, it becomes roughly $7,800 per year after 10 years without adding a single new dollar of your own. That's why $100,000 comes up so often in long-term investing conversations. It's not a magic number, it's a practical one. It's where gains start stacking on top of gains in a way that you can clearly see. It's important to be clear about one thing. Compounding doesn't start at $100,000, it starts at $1. What changes at $100,000 is visibility. The snowball finally has enough weight for gravity to help. Growth becomes more consistent, more forgiving, and more resilient to bad years. Now, in a couple of minutes, I'll show you a portfolio that accelerates that process. And at the end, I'll show you John's two paths to $1 million portfolio paying over $5,000 a month in dividends. One uses the lowest one-time payment needed, and the other gets there using the lowest daily contributions possible in single digits per day. So up until now, the focus has been on size, how much money you have and when compounding becomes visible.
This chapter shifts the focus to direction, not how much income you earn today, but how fast that income can grow over time. For this, you need to understand a couple of things, first of which is the dividend yield, which tells you what's happening right now. Meanwhile, dividend growth tells you where things are headed. A high dividend yield feels good because it pays you immediately. Cash shows up, it feels productive, but if that income barely grows, it slowly loses power. Prices rise, inflation eats into it, time stops helping. The income stays flat while everything else gets more expensive. Dividend growth works differently. Instead of paying you more today, it commits to paying you more tomorrow, and then more after that. And more after that. Each increase builds on the last one. Over long periods, those increases matter more than where you started. This is why growth changes the outcome. Compounding doesn't care about comfort, it cares about momentum. Income that grows faster gives compounding something to work with. Every year, the base gets larger. Every reinvestment gets heavier. The system gains speed without asking you for more effort. This doesn't mean yield is bad. Yield helps you get started, but growth decides how far you go. And for that to work, the businesses behind those dividends have to be strong enough to keep raising them, which brings us straight to the checklist that actually matters when you're building a portfolio meant to compound. Compounding only works if the businesses underneath it can support it. Weak foundations give out long before compounding has a chance to build momentum. The goal here isn't to find exciting companies, it's to find reliable ones. Businesses that generate consistent cash year after year and have a clear history of sharing that cash with shareholders through dividends. You need stocks that have a long track record of paying and raising dividends. Payout ratios play a big role here. When too much of a company's earnings go toward the dividend, growth becomes fragile. Healthy payout levels, which are below 70%, leave room for increases even during tougher periods, which keeps the income stream moving forward. Earnings growth is the next checkbox. Dividends rise when profits rise. Companies that grow earnings over time can increase payouts naturally without stretching themselves. Finally, and very important, keep everything simple. A portfolio designed for compounding should not require frequent changes. Low turnover reduces mistakes, taxes, and emotional decisions. The objective isn't to react, it's to hold. Strong businesses, growing payouts, sustainable finances, and patience. That combination doesn't look exciting in the short term, but over decades, it's exactly what compounding needs to work properly. John applied the checklist and started with SCHD, the Schwab US Dividend Equity ETF. This became the income anchor in his portfolio. SCHD currently offers a dividend yield of about 3.79%. Over the last 10 years, its dividend has grown at roughly 10.61% per year, while the share price has appreciated around 7.88% annually. Income shows up early. That income keeps growing, and the price moves steadily without depending on any single company. Next came Abbott Laboratories, ticker ABT. The dividend yield here is around 2.02%, so the income starts smaller. Over time, it builds. Dividends have grown about 9.41% per year over the past 10 years, and the share price has appreciated roughly 10.74% annually. ABT represents stability and consistency. It doesn't pay much up front, but it compounds through earnings growth and reliable dividend increases. Then there's AbbVie with the ticker symbol ABBV. This one sits in the middle. ABBV currently yields about 3%, and its dividend has grown at an impressive 12.5% per year over the last decade. On top of that, the stock has delivered about 13.21% annual price appreciation. AbbVie shows what happens when income and growth coexist. The yield adds weight early, and the growth accelerates compounding over time. Next is Interparfums with the ticker IPAR, which plays a different role. IPAR's current dividend yield is around 3.78%, but the standout metric is dividend growth. Over 10 years, dividends have grown at roughly 20.16% per year, with share price appreciation around 13.46% annually. Lowe's, ticker LOW, rounds things out for John's portfolio. The current dividend yield is about 1.97%. Dividend growth has averaged roughly 16.51% per year over the past decade, and the share price has appreciated about 12.33% annually. Once John had the full portfolio in place, the next step was to understand what the portfolio was actually producing as a whole. To calculate the portfolio's dividend yield, he kept it simple. He wrote down the yield for each holding. SCHD at 3.79%, ABT at 2.02%, ABBV at 3%, IPAR at 3.78%, and LOW at 1.97%. He added them together, which comes out to 14.56. Then he divided that number by 5 since there are 5 stocks. That gives a portfolio dividend yield of 2.91%. That single number tells you a lot. It shows how much income the portfolio produces right now before growth does any heavy lifting. You can use the same process for the other metrics. Take the dividend growth rates, add them up, divide by 5, and you get the portfolio's average dividend growth rate, which for John comes out to 13.84%. Do the same with the annual share price appreciation numbers, and you get an average of 11.52% for the portfolio. Once John understood the portfolio itself, the next question became how to feed it. There are 2 common paths. One focuses on consistency, the other focuses on the starting scale. Both work, they just feel different along the way. The first path begins with a one-time investment and then lets time do most of the work. The money starts compounding immediately, and progress feels more visible early on because the base is already there. The second path grows through regular small contributions. Money goes in steadily without worrying about timing or market swings. Early progress feels slower because most of the growth comes from the contributions themselves. Both paths use the same portfolio underneath, same yield, same growth, same behavior. The only difference is how the money enters the system. And you can choose any one that fits your pocket. Now let's look at the lowest amount needed to reach $1 million portfolio at roughly $5,000 a month in dividend income, starting with the one-time investment path. For the one-time investment path, John starts with $17,000 up front and adds nothing after that. No daily deposits, no monthly contributions, just time, reinvestment, and the portfolio doing what it's designed to do. After 1 year, the portfolio is projected to be valued at about $19,454. After 10 years, it's projected to reach roughly $67,344. At this stage, progress still looks modest, which is typical early in the compounding process. Between years 10 and 20, the portfolio is projected to cross the $100,000 mark around year 13. That's where the behavior starts to change. Reinvested dividends begin adding noticeable weight, and growth becomes easier to see from year to year. By year 20, the portfolio is projected to be valued at around $286,745. From this point on, compounding plays a much larger role in the portfolio's growth. By year 30, the portfolio is projected to reach approximately $1,335,922. At that level, projected annual dividend income is about $64,453, which works out to roughly $5,371 per month. When you break down the projected growth, the total value added over time comes to about $1,318,922. Of that amount, roughly $920,748 is projected to come from capital appreciation, while about $398,174 is projected to come from reinvested dividends. Now let's look at the projected outcome for the second path, where John builds the portfolio through steady contributions instead of starting with a lump sum. Let's suppose John contributes $7 per day with $0 invested up front. After 1 year, John would have invested around $2,555. This sets the stage for future growth. After 10 years, it's projected to reach roughly $51,550. Between years 10 and 20, the portfolio is projected to cross the $100,000 mark around year 14. That's where compounding becomes easier to notice as reinvested dividends and price appreciation start playing a larger role. By year 20, the portfolio is projected to be valued at around $273,258. From here, growth becomes more self-sustaining, with less reliance on new contributions. By year 30, the portfolio is projected to reach approximately $1,329,766. At that point, projected annual dividend income is about $64,033, which works out to roughly $5,336 per month. Looking at the projected growth over time, the total value added comes to about $1,253,116. Of that amount, roughly $871,876 is projected to come from capital appreciation, while about $381,240 is projected to come from reinvested dividends. If your life looks normal, your income feels average, and investing feels out of reach, this is for you. That's where John is too. He wants a plan that fits into his life without forcing changes. He looks at his budget, sees that $70 a week, about $10 a day, is realistic, and builds everything around that. In this video, I'll show you exactly how that setup works, how each ETF has a specific role, how spreading money the right way keeps things balanced. I'll show you John's portfolio and the ETFs he selected using a clear set of criteria. And in the end, I'll show you how this portfolio could potentially turn John's $70 a week into a portfolio worth $1 million. To see why this approach works so well, we need to strip investing down to its simplest form and start with the one idea that makes everything else fall into place: ETFs. ETFs sound complicated at first, but the idea behind them is actually very simple. Think of an ETF like a basket. Instead of buying one single stock and hoping it does well, you're buying a basket filled with many companies at the same time. That way, if one company struggles, it barely dents the overall basket. That's why John's comfortable using them. He's not trying to beat the market or find the next hot stock. He just wants a simple way to grow his money without reacting to every headline or market swing. Inside the basket, money grows in two main ways. One is share price growth. As the companies inside the ETF grow, become more profitable, and keep improving, the value of the basket rises with them. The other is dividends. Some companies share part of their profits with investors, and those payments get passed on to you. When John reinvests those dividends, they buy more shares, which then create even more growth and income over time. This is where weekly investing starts to matter. By putting in a small amount every week, John doesn't worry about timing the market. Some weeks, prices are higher, some weeks they're lower, and over time, it evens out. What matters is that he keeps showing up and stays invested. Vanguard ETFs fit this approach perfectly. They're low-cost, broadly diversified, and built to track large parts of the market instead of betting on a few winners.
That makes it easier to hold through ups and downs without second-guessing decisions or making emotional moves, which is exactly why this same approach shows up again and again when you look at how successful long-term investors actually invest their money. They don't spend their time chasing hot stocks or trying to predict the next big winner. Instead, they focus on owning broad pieces of the market and letting time do the heavy lifting. One of the most well-known examples is Warren Buffett. Over and over again, he's explained that most people are better off owning low-cost index funds rather than trying to beat the market. And his logic is simple. When you own a broad slice of businesses, you benefit from overall economic growth without needing to guess which company will outperform next year. Jack Bogle, the founder of Vanguard, built his entire investing philosophy around this same idea. He believed that diversification, low fees, and long-term discipline matter far more than clever strategies. By spreading your money across thousands of companies and keeping costs low, more of your returns stay in your pocket. Beyond broad market investing, many professionals emphasize balance. Growth-focused investments like technology drive long-term appreciation, while income-producing assets, such as real estate, add stability and cash flow. Combining growth, diversification, and income reduces resilience on any single outcome and creates a portfolio built to hold up across market cycles. And that leads to the next question. How do you actually choose the investments that make this balance work? Before putting any money into an investment, it's important to understand the rules behind why it was chosen. It's built on a small set of criteria that consistently show up in long-term successful portfolios. First, the investment has to be broadly diversified. Instead of relying on a handful of companies, these investments spread your money across entire sectors or the market as a whole. That lowers risk because no single company or event can derail the entire portfolio. Next, it needs to have a proven track record. These investments have been around long enough to show how they perform across different market conditions, including recessions, bull markets, and periods of high inflation. Longevity matters because it reveals resilience. Cost is another big one. Fees may look small, but over decades, they quietly eat into returns. That's why low expense ratios matter so much. The less money going to fees, the more stays invested and compounds over time. Liquidity and scale also matter. These ETFs tend to be easy to buy, easy to hold, and large enough to handle steady contributions without friction. Finally, there's balance. No single ETF has to do everything. Some are there to drive growth, others to produce income, and others to add stability. When those pieces work together, the portfolio isn't depending on one outcome to succeed. With those rules in place, the next step is choosing the foundation on which the rest of the portfolio is built. For John, that foundation is the Vanguard Total Stock Market Index Fund, VTI. When I call VTI the foundation, I mean it acts like a whole U.S. economy button. Instead of buying individual stocks, you're buying a single fund that owns a wide range of U.S. businesses all at once. That way, you're not betting your future on just a few names. You're spreading your money across the economy as a whole. That diversification shows up clearly in the sector mix. About 33.23% sits in technology, followed by 12.91% in financials, 10.46% in healthcare, 10.37% in consumer cyclical, 10.17% in communication, and 8.73% in industrials, with smaller exposure to energy at 2.98% and real estate at 2.39%. No single industry gets to control the outcome. Looking at the holdings, the top 10 holdings show what actually drives the fund. Companies like Apple, Nvidia, Microsoft, Amazon, Broadcom, Alphabet, Class A and C, Meta Platforms, Tesla, and Berkshire Hathaway sit at the top, and together make up about 34.75% of the portfolio. These are established leaders already shaping the global economy. So as they grow, VTI grows with them. while still staying exposed to many other businesses in the background. Now here's the part that many people overlook: size and cost. VTI is massive, with around $2.06 trillion in fund assets and about $574.76 billion at the class level. In plain English, that usually means it's easy to buy and sell, and it tends to run efficiently. And the fee is almost nothing. The expense ratio is just 0.03%, which means fees barely make a dent in long-term compounding. Performance over time is where this structure really proves its value. Over the last year, VTI is up about 16.17%. Over 5 years, it's gained roughly 74.37%. Stretch that out to 10 years, and the total return is about 244.85%. Those numbers don't come from clever timing, they come from staying invested in the entire market as it grows. Income plays a supporting role here. The current dividend yield is about 1.11%, and dividends have grown at roughly 6.16% per year over the last decade. While the yield itself earns a D+ grade, the consistency matters more, with about 24 consecutive years of dividend payments. Combined with solid dividend and momentum grades, VTI does exactly what a foundation should do: grow steadily, pay reliably, and set the stage for more focused growth on top of it. So that's the foundation. As for growth, John adds the Vanguard Information Technology Index Fund ETF, VGT. After that, I'll show you one more ETF for the portfolio, and in the end, I'll show you how this portfolio could potentially turn John's $70 a week into a portfolio worth $1 million. But first, let's check out the growth part of the portfolio, VGT. This portion of the portfolio is intentionally designed to push long-term growth faster by leaning into one sector that has consistently driven market returns: technology. VGT focuses almost entirely on companies building the infrastructure, software, and hardware that power the modern economy. You can see that concentration right away. About 98.22% of the fund is in technology, with only small slices in areas like communication services at 7.3% and financials at 0.58%, plus tiny exposure to a few other sectors. This isn't designed to be balanced on its own. It's designed to be focused. When innovation, productivity, and digital transformation keep moving forward, this fund benefits directly. That focus becomes even clearer when you look at the top holdings. NVIDIA sits at roughly 16.61%, followed by Apple at 15.3% and Microsoft at 12.42%. Broadcom, Palantir, AMD, Oracle, Cisco, IBM, and Micron round out the top 10. Together, those 10 companies make up about 59.09% of the fund. They're companies already shaping areas like artificial intelligence, cloud computing, semiconductors, and global data infrastructure. Structurally, VGT is much more concentrated than VTI. It holds about 328 companies, which means each position carries more weight. Even so, costs stay low. The expense ratio is just 0.09%. Liquidity scores an A+, and the fund manages about $129.96 billion in assets. For John, that means it's easy to invest in, easy to add to weekly, and built to scale. The performance numbers explain why this level of concentration exists. Over the past year, VGT is up about 21.24%. Over 5 years, it's gained roughly 115.26%. Stretch that out to 10 years, and the total return jumps to around 657.71%. That long-term track record is exactly why this fund plays such a powerful role in a FIRE-focused portfolio. Income isn't the goal here, and that's expected. The dividend yield is only about 0.4%, earning an F grade for yield and a D grade for dividend growth. Dividend growth over 10 years is around 1.76%, which is modest at best, but that's expected. Technology companies tend to reinvest profits into innovation rather than paying them out as dividends. VGT's role in the portfolio is simple: maximize capital growth. And when it's paired with a broad market foundation and an income-focused piece, it adds the fuel that can meaningfully shorten the path to financial independence. So, with the foundation and now growth in place, the last piece is income and balance. And for that, John has the Vanguard Real Estate Index Fund ETF, VNQ. This ETF is designed to add steady income and exposure to real estate assets, which behave very differently from technology stocks or the broader market. Real estate doesn't always move in sync with stocks, and that difference is exactly why VNQ earns its place here. VNQ is almost entirely invested in real estate, with about 98.85% of the fund allocated to REITs, real estate investment trusts. The rest is spread lightly across areas like communication services, energy, and industrials, with a small cash position. In simple terms, this fund owns companies that own properties: office buildings, warehouses, data centers, cell towers, healthcare facilities, storage units, and retail spaces. John gets exposure to all of that without managing tenants or worrying about repairs. The top holdings show how broad that exposure really is. The largest position is the Vanguard Real Estate 2 Index, followed by companies like Welltower and Prologis. American Tower and Equinix add exposure to cell towers and data centers, while names like Simon Property Group, Digital Realty, Realty Income, CBRE Group, and Public Storage cover retail, logistics, leasing, and storage. Together, the top 10 make up about 52.49% of the fund, which spreads income across multiple real estate models instead of relying on one type of property. The fund holds around 167 companies, making it more concentrated than VTI, but still diversified across many property types. Its expense ratio is 0.13%, which earns it an A grade for expenses, and liquidity is rated A+, meaning it's easy to buy, sell, and scale over time. Total assets under management sit near $65 billion, so this is not a niche or experimental fund. Performance reflects that role. Over the past year, returns have been modest at about 1.03%. Over 5 years, gains are roughly 6.06%. Over 10 years, about 15.18%. These numbers won't excite growth investors, but they don't need to. Where VNQ really stands out is income. The current dividend yield is about 3.9%, earning it a solid B grade for yield. That's significantly higher than both VTI and VGT. So, when John combines VNQ with his growth-focused ETFs, the portfolio becomes smoother and more resilient. It adds cash flow he can reinvest now and potentially rely on later, which makes the entire strategy more balanced and retirement-ready. Here's how this looks week to week for John. This strategy is built around investing $70 per week in a fixed allocation. For John, the plan is simple. Every week, he invests $70 and follows the same split every time. Half of it, $35, goes into the broad market through VTI, giving him exposure to more than 3,500 U.S. companies across every major sector. Another 30%, that's $21, goes into technology through VGT, where long-term growth comes from innovation and productivity. The remaining 20%, which comes to about $14, goes into VNQ, adding real estate income and diversification through property-based cash flow. At $70 per week, that's $3,640 per year invested automatically, without timing the market. Over time, this consistency is what allows compounding to do the heavy lifting. Now let's look at what the long-term projections show if John simply keeps doing this. For the first year, John's portfolio will be the same as his contribution, $3,640, assuming 52 weeks in a year.
After 10 years, John's total contributions would reach $36,400. Based on the projections, the portfolio would be valued at about $69,562. At this point, the growth is starting to pull ahead of what he's putting in. By year 20, total contributions would add up to $72,800, while the portfolio would grow to approximately $310,287. Most of that value wouldn't be coming from new money anymore, it would be coming from compounding doing the work in the background. After 30 years, John's total investment amount would be $109,200. That's what he puts in. The portfolio, however, is projected to reach about $1,126,635. That means roughly $1,017,435 of the final value would be projected to come from growth and reinvested dividends, not from John's direct contributions. Breaking down the total value further, about $1,002,450 would be projected to come from share price growth, with about $14,985 coming from dividends reinvested along the way. No more income taxes on Social Security. And every retiree said, wait a minute, you mean the money I already earned, already paid into, and already waited decades for? Yes. That money, said Trump during the 2024 election campaign. Now fast forward to today. Fireworks, flags, hot dogs, and boom, the One Big Beautiful Bill Act, aka OBBBA, becomes law. But here's the twist. The bill does not completely eliminate taxes on Social Security. However, and this is important, it does something else. Something easier to miss. Something accountants immediately noticed and seniors absolutely needed to understand. Instead of killing Social Security taxes outright, the bill creates a brand new extra $6,000 deduction just for seniors. Now, before your brain goes, great, sounds complicated, I'll ask my accountant. Take a breath. You don't need to be a tax expert to follow this. In this video, I'll walk you through it step by step in plain English so it actually makes sense. I'll be answering the questions seniors are already asking. Who qualifies? Does this apply to 2026 taxes, or is it one of those future you problems? To answer that, we need to back up just a bit and look at what Congress actually passed. On July 4th, 2025, fireworks went up, and so did a very large tax bill. The One Big Beautiful Bill officially became law. Here's the first hard fact that matters. Without this bill, the 2017 tax cuts were scheduled to expire at the end of 2025. That meant higher tax rates, smaller deductions, and a surprise tax increase starting in 2026, including for retirees. Congress stopped that. The lower tax brackets and the higher standard deduction are now locked in permanently. That alone prevents a tax hike for millions of seniors. But that wasn't the real change. On top of keeping the old rules in place, Congress added something new. A brand new deduction just for seniors, and this is where the math on your tax return starts to shift. Starting in tax year 2025, anyone aged 65 or older can claim an extra $6,000 deduction per person. Married couple, both over 65? That's $12,000 on top of the regular standard deduction. So let's slow this down with numbers. Before this new law, the IRS basically drew a line in the sand. If you were a single senior, $16,950 of your income was protected from tax. Anything above that started counting. For married couples, that protected amount was $33,100. That was the old world. Now let's look at what changed. Nothing was taken away. Congress didn't replace anything. They stacked something new on top. So today, a single senior doesn't just get one deduction, they get 3 layers working together. The regular standard deduction, the extra amount for being over 65, And now this new senior bonus deduction worth $6,000. When you stack those three together, the IRS can't touch $23,750 of income for a single senior. That's $6,800 more dollars protected than before. For married couples, the jump is even bigger. Before, $33,100 of income was shielded. After the new law, when both spouses are over 65, that shield grows to $46,700. That's $13,600 of additional income that simply doesn't count for federal tax purposes. Now, here's why that matters. Under the old system, the IRS had tripwires built in. Once your total income crossed certain thresholds, they didn't just tax your pension or IRA withdrawals, they reached into your Social Security too. First, up to 50% of your benefit became taxable. Cross another line, and that jumped to as much as 85%. It didn't matter that Social Security benefits were your retirement money, the IRS still wanted their cut. For married couples, if that number is $32,000 or less, Social Security isn't taxed at all. Between $32,000 and $44,000, up to 50% can be taxed. Above $44,000, up to 85% can be taxed. For single filers, those lines are $25,000 and $34,000. Those thresholds never changed. What changed is how easy it is to stay below them. With the new deduction in place, taxable income drops. When taxable income drops, provisional income drops. And when provisional income drops far enough, Social Security slides out of the taxable zone. That's why under the new rules, about 88% of seniors receiving Social Security are expected to owe $0 in federal tax on those benefits. Before this change, that number was closer to 64%. That's really what this bill does for seniors. It doesn't make big promises, it just changes the math. But once people notice their tax bill shrinking, something else takes over. Because taxes aren't the most expensive part of retirement, healthcare is. And that's where things start to feel different. For years, many seniors were protected by something they didn't even know existed: automatic enrollment into certain Medicare savings programs. These programs help low-income seniors pay for Medicare Part B premiums, deductibles, and copays. No forms, no annual panic. Under the new bill, that automatic enrollment was turned off. But Medicare itself is not cut. Your Medicare card is safe. What changed is the extra help layer. Before the bill, if a senior qualified financially, the system often enrolled them automatically. After the bill, seniors must apply, reapply, and re-verify eligibility on their own. Now, let's put numbers on why this matters. In 2026, the Medicare Part B premium is about $202 per month, or $2,424 per year. Medicare savings programs often covered that cost for eligible seniors. If the assistance stops, either you didn't enroll or you missed filing, that $202 comes straight out of the Social Security check until everything is sorted out. So if someone is receiving around $1,800 a month from Social Security, losing that help means that they're suddenly living on about $1,600 instead. Same expenses, same needs, just less money coming in. For some seniors, this won't be an issue. If you're comfortable with forms, online portals, or you have someone helping you stay on top of deadlines, you'll likely keep the assistance without interruption. But for others, especially those dealing with health issues, mobility limits, or paperwork confusion, even a temporary lapse can create real financial stress. And that's the trade-off built into this change. The tax relief, on one side, comes with more responsibility on the other. If you're organized, informed, digitally comfortable, or have family helping, you'll likely reapply on time and keep the assistance. But if you're homebound, confused by paperwork, unaware the rules changed, or simply overwhelmed, you can lose help, not forever, but long enough to feel financial pain. And this wasn't accidental. Supporters of the bill accepted this trade-off because tightening enrollment rules reduced federal spending. Those savings helped pay for the tax relief seniors are enjoying on the front end: less automation, more responsibility. Which brings us to the situation most seniors are already dealing with every day: the cost of living squeeze. Before this law, the pattern was pretty frustrating. Income stayed mostly the same, but expenses kept creeping up. Social Security had cost of living increases, but they often didn't keep pace with what people were actually paying, especially for healthcare, housing, and utilities. This bill doesn't change Social Security payments. There's no bonus check, no adjustment to how benefits are calculated. Instead, it changes the outcome in a different way. And here's how that works. Your Social Security stays the same, but your deductions go up. When deductions go up, taxable income goes down. When taxable income goes down, your federal tax bill shrinks, sometimes all the way to zero. So even though your benefits didn't increase, the amount you get to keep does. For many seniors, that works out to about $1,200 to $2,000 a year in tax savings, depending on income. That's roughly $100 to $160 a month staying in your pocket, enough to help with groceries, prescriptions, or the electric bill. It doesn't feel like a raise on paper, but it feels like one in real life. That's why a lot of seniors describe this as a silent raise. Nothing flashy, just a little more breathing room. But, and this is the line that matters, this relief is not evenly distributed. This bill isn't really designed for very low-income seniors. Most of them were already paying little or no federal tax, so there isn't much to reduce. And it's not aimed at wealthy retirees either. At higher income levels, the deduction starts to phase out. The real impact shows up in the middle. Seniors over 65 who have Social Security plus a small pension, maybe some part-time income, maybe withdrawals from a traditional IRA. Married couples filing jointly tend to see the biggest effect. These are the households where the new deduction actually changes outcomes. And that tells you a lot about the thinking behind the bill. The goal wasn't to expand benefits, it was to prevent tax increases on ordinary retirees without growing long-term spending. Now here's the detail almost everyone misses. Some parts of this bill are permanent, some are temporary. Lower tax brackets? Permanent. Standard deduction structure? Permanent. Estate tax thresholds? Extended. But the extra $6,000 senior deduction is different. It expires after 2028 unless Congress steps in. That means seniors are living inside a window, a good one, but a limited one. From this year through 2028, the rules are unusually favorable. And that window creates an opportunity, a chance to move money deliberately while taxes are lower than usual into something that won't be taxed later, like a Roth IRA. And that's where this starts to get practical. This law doesn't talk about Roth conversions in big, bold letters, but it makes them far more useful for the right seniors. To make sense of this, you need to understand how these retirement accounts actually work. So, a traditional IRA is built around paying taxes later. Most people didn't pay taxes when the money went in. It grew without taxes for years. But when the money comes out in retirement, the IRS treats every dollar as income, and it is taxed as such. Not to mention, at a certain age, you're forced to take money out whether you need it or not. A Roth IRA works the opposite way. With a Roth, you pay the tax first. After that, the money grows without future taxes. When you take it out later, it comes out tax-free. And there are no required withdrawals pushing income into years when you don't want it. A Roth conversion is simply moving money from a traditional IRA into a Roth IRA. When you do that, the IRS looks at the amount you move and says, that counts as income this year. Normally, that would trigger a tax bill. And this is the part that matters. Roth conversions are not automatically tax-free. There's no special exemption. The only reason a conversion can happen without creating taxes is if your taxable income is already low enough and your deductions are large enough to absorb it. That's what this new senior deduction changes. Because deductions are higher now, many seniors have income space they didn't have before. Space where income can be recognized without crossing tax brackets, without pulling Social Security into taxation, without triggering higher Medicare premiums. In those years, a portion of a Roth conversion can fall into that unused space, not because the IRS ignores it, but because the math never gets high enough to generate tax. So what this strategy really does is let you choose when you pay taxes, or in some cases, lock in years where you effectively pay very little or none, instead of being forced to pay later when rates, required withdrawals, and premiums may all be higher. Once the money is inside the Roth, it's done. No future taxes on growth, no taxes on withdrawals, no required distributions forcing income at the wrong time. That's the opportunity this window creates. It doesn't mean everyone should convert, and it doesn't mean every conversion is tax-free. It means that for a few years, the numbers finally line up in a way that usually don't. This makes more sense if we slow down and look at one of these households. Take Blake and Bea. They're a married couple living right in the middle of the chart, about $72,000 of total income, roughly half from Social Security, and the rest from other sources like a pension or IRA withdrawals. Before this law, that income level was a problem. Once their income crossed the IRS thresholds, Social Security didn't stay protected. First, part of it became taxable. Then at higher levels, as much as 85% of it got pulled into the tax calculation. Even though Social Security was their retirement money, the IRS still treated it like taxable income. That's what the old rules did. Now, look at what changes under the new law. Blake and Bea don't lose anything they already had. All the existing deductions stay in place. But on top of that, they get a new senior deduction because they're both over 65. That extra deduction lowers their taxable income just enough to keep them below the IRS tripwires. And once that happens, their Social Security drops out of the tax calculation entirely. That's why on this table you see a $12,000 deduction creating more than $14,000 of tax impact. The deduction isn't just reducing taxes dollar for dollar, it's changing whether Social Security is taxed at all. For someone like Avery or Bailey, single filers in that same middle range, the effect can be even stronger. A $6,000 deduction can protect far more than $6,000 of income by keeping them under the line. Very low-income households don't see much change because they weren't paying much tax to begin with. Very high-income households don't see much change as well because the deduction phases out. The benefit lies in the middle, and once Social Security drops out of the taxable zone, something important happens. You get room. Room to recognize income without triggering taxes. Room to move money strategically. Room that didn't exist before. That's where planning choices like Roth conversions suddenly start to make sense. Now imagine a married couple, both over 65, living off Social Security plus some other retirement income. After all deductions are applied, the standard deduction, the age-based increase, and the new $12,000 senior deduction because they're a married couple, this couple's taxable income for 2026 comes out to about $23,700. That number matters. For married couples filing jointly, the 10% tax bracket goes up to $24,800. So at $23,700, this household is still entirely inside the lowest tax bracket. Now look at what that creates. This couple has money sitting in a traditional IRA. That money has never been taxed. If they wait, future withdrawals, especially required minimum distributions, will be fully taxable. So instead of waiting, they decide to move some of that money now. They convert $12,000 from the traditional IRA into a Roth IRA. Normally, that $12,000 would count as new income and trigger taxes. But in this case, the senior deduction acts like a buffer. It absorbs the conversion before it creates a federal tax bill. Nothing here was hidden. The income was reported. The IRS saw it. The math just never got high enough to trigger tax. And even after that conversion, they're not pushed into high tax territory. Income above the 10% bracket doesn't jump to extreme rates. It moves into the 12% bracket, which runs all the way up to $100,800 for married couples. That means this household can continue moving money out of a traditional IRA slowly while taxes are still very low. Once the money is inside the Roth, it's done. It grows tax-free, it comes out tax-free, and it never forces withdrawals later in retirement. They're essentially building a tax-free inheritance for their grandkids, while the sale on tax rates is still active. There is a catch to all of this, and it shows up in the fine print. The extra senior deduction doesn't last forever if income climbs too high. For a married couple, once total income reaches $150,000, that $12,000 deduction starts to shrink. For every dollar earned above that level, 6 cents of the deduction disappears. And if income reaches $250,000, the deduction is gone completely. Now, imagine a retired couple with a traditional IRA and income sitting close to the $150,000 phase-out line. They want to avoid pushing their income any higher because once they cross that line, the $12,000 senior deduction starts to disappear. Every dollar above $150,000 chips away at it, and losing that deduction can trigger higher taxes and higher Medicare costs at the same time. Now, normally, if this couple needs money from their IRA, they take a withdrawal. The IRS treats it like a paycheck. It shows up as income. It pushes them closer to or over that $150,000 danger zone. But there's another option. Instead of taking the money themselves, they tell their IRA custodian to send $5,000 directly to a charity they support. This is called a Qualified Charitable Distribution, or QCD. Here's why that's powerful. That $5,000 never shows up on their tax return as income. It doesn't get added and then deducted later. It simply disappears from the IRS's view. On paper, it's as if the money was never theirs. Because of that, their adjusted gross income stays below $150,000, which preserves the full $12,000 OBBBA senior deduction. And there's another layer. Even while taking this standard deduction, they get the full tax benefit of that $5,000 charitable gift. Under the old rules, you usually had to choose, either itemize your donation or take the standard deduction. With a QCD, they get both. There's a third benefit too. By keeping income lower through QCDs, they also avoid IRMAA surcharges. Those are the high-income Medicare penalties that can sharply increase monthly premiums, in some cases nearly doubling what someone pays for Medicare Part B. So that one move does 3 things at once. It keeps income below the $150,000 phase-out line, it protects the $12,000 senior deduction, and it helps avoid higher Medicare premiums. That's the synergy in this strategy. It's not about chasing loopholes, it's about controlling what shows up as income, so one decision doesn't set off a chain reaction of taxes and penalties. And when this is done alongside Roth conversions, it gives retirees a way to manage income carefully during this short window before the senior deduction expires after 2028. That's how the pieces fit together. The OBBBA gave the seniors a tax break carrot, but it's waving a massive administrative stick right behind it. They're now the managers of their own survival. The government isn't coming to save them with automatic anything anymore. It's a trade-off. More cash in the pocket, but more paperwork on the desk. They have until 2028 to ride this tax-free wave before the senior deduction expires, which means right now, they aren't just retirees. They're full-time financial strategists in a high-stakes game of don't forget the forms.
Right now, there are millions of robots working every single day inside factories, warehouses, hospitals, and logistics centers around the world. Not prototypes, not pilots, real machines doing real work at scale. According to industry data, there are now over 4 million industrial robots actively operating in factories worldwide, a number that has more than doubled over the past decade.
That alone should tell you something important has already changed. What matters just as much is where this is going next. Industry forecasts now expect that number to climb towards 7 to 8 million industrial robots globally by the early 2030s, driven by automation in manufacturing, logistics, healthcare, and infrastructure. Most people think robotics is about machines. It's not. The real value is in what those machines teach the systems behind them and who owns that learning. That's the part almost nobody is pricing correctly. In this video, I'm going to show you why most robotics investments miss the real opportunity. We'll break the industry into 4 tiers, look at where value actually compounds, and at the end, I'll show you a portfolio in the 4 tiers of robotic stocks that could potentially turn a $10,000 investment into a $10 million portfolio over the long run. But before we get there, we need to understand why most investors misread the robotics story. Many investors think robotics is important but still early, something that'll matter more in, say, 5 or 10 years from now. That view is understandable. For decades, robotics was expensive, slow to evolve, and limited to tightly controlled environments. But that mental model no longer fits what's happening. While headlines focus on flashy demos, the real shift is far more consequential. Robots aren't isolated machines anymore. They operate as connected systems. Each robot feeds data into shared intelligence. Each improvement spreads across the entire fleet. Once that loop exists, progress stops being linear. This is why robotics doesn't arrive in a sudden, dramatic moment. There's no clean adoption curve. Capability builds gradually. Then efficiency suddenly jumps, and those jumps only become obvious after the fact. That's where investors get tripped up. If robots are already widespread, why don't all robotic stocks behave the same way? Why do some compound while others stall even though they're tied to the same trend? The problem is that most investors still analyze robotics the old way. They count robots, factories, and deployment rates. If one country or company installs more machines, it's assumed they're winning. That logic made sense when robotics was purely physical, but robotics behaves differently today because its economics flipped, slowly but completely. In the old model, robots were rigid. Every movement was programmed by hand. If a task changed, engineers rewrote code, tested it, and deployed it one machine at a time. That worked on a small scale. It broke on a large scale. Each robot operated in isolation. Improvements had to be copied manually. Learning was slow and expensive. Scaling meant repeating the effort. That's no longer how robotics works. Today, intelligence lives in shared models. Instead of programming thousands of robots individually, one system is trained centrally and deployed across an entire fleet. Every robot runs the same core intelligence adapted to its specific environment. That changes the math. Training intelligence can be costly up front, but once trained, deploying it to one robot or 1,000,000 costs almost nothing. The marginal cost of intelligence collapses. Improvement becomes software-like. Now every robot becomes a sensor. Every mistake, correction, and edge case is captured and fed back into the system. The next update reflects the experience of the entire fleet at once. Robots don't just execute tasks, they learn collectively. This is why progress accelerates after years of slow buildup. Once the learning loop is in place, each deployment makes the next one easier. Each improvement spreads instantly. We've seen this before. In smartphones, the companies that shipped the most devices didn't capture most of the value. Software, platforms, and ecosystems did. Robotics is following the same pattern. As machines get cheaper and easier to deploy, installation alone stops being special. What matters is adaptability, learning speed, and whether the system improves over time. Scale without differentiation doesn't protect margins. Intelligence does. It also explains why leaders pull away. Which leads to the next question. Where does that value actually live?
This is where most of the confusion comes from. Robotics gets treated as a single trend, when it's really a system with distinct layers. Once you stop looking at robotics as one category and break it into tiers, the value map becomes much clearer. Value doesn't spread evenly across robotics. To make it simple, I've divided the robotics stocks into 4 tiers. At the base are the muscles. This is physical execution, robot arms, actuators, mechanical systems that turn digital commands into real-world movement. Nothing works without this layer, but over time, competition pushes it toward infrastructure. It becomes reliable, necessary, and lower margin. Above that are the eyes and nerves. Perception systems, cameras, sensors, machine vision allow robots to operate outside controlled environments. This tier is what lets robots adapt instead of repeat. Above perception is the brain. This is where intelligence lives: computing, training platforms, simulation, and orchestration software. This layer compounds learning. Data from every robot gets turned into better decisions for the entire system. At the top are the operators. These are the companies that deploy robotics so well that it becomes a moat. They don't just buy machines, they integrate systems, coordinate them in real time, and continuously optimize workflows. This is where robotics turns into operating leverage. Here's the critical insight. As robotics scales, value migrates upward. Physical execution becomes standardized. Middle layers compress. Intelligence and orchestration capture a larger share of the upside. Every layer matters. The system collapses without the base, but from an investment perspective, not every layer compounds the same way. Some grow steadily, some accelerate, and some get squeezed as competition increases. So with the map in place, let's start with Tier 1, where everything physical actually happens. Tier 1, the muscle layer. This is where digital instructions turn into real-world action. Robot arms, actuators, precision tools, and systems that move, cut, lift, and manipulate objects with accuracy. Nothing in robotics works without this layer. Every higher level depends on it doing its job reliably every single time. Boston Scientific fits here cleanly. At its core, the company builds robotic systems that execute physical tasks with extreme precision, primarily in medicine. These aren't consumer robots or experimental platforms. They're clinical tools designed to operate inside the human body, where tolerances are measured in millimeters and failure isn't an option. What makes this a robotic story isn't the medical setting, it's the function. Boston Scientific's systems convert digital commands into controlled physical movement. Catheters bend, rotate, and deliver energy with sub-millimeter accuracy. Mechanically, it's the same logic as an industrial robot arm, just miniaturized and refined for living tissue. This also explains why Tier 1 behaves differently. As robotics spreads, demand for precise execution grows steadily. Hospitals adopt robotic systems for consistency and outcomes, the same way factories adopt automation for reliability. But progress here is incremental. Better designs, tighter tolerances, wider adoption, no sudden leaps. That doesn't make this tier less important, it just makes it foundational. Without reliable muscles, intelligence doesn't matter. But from an investment standpoint, this layer usually compounds at a slower, more predictable pace. It benefits from scale, but it rarely produces explosive upside on its own. That steady profile shows up in how the market views Boston Scientific. Analysts broadly rate the stock a buy, with average targets implying roughly low 30% upside over the next year. That outlook fits the role this layer plays: durable demand, improving adoption, and predictable growth rather than speculation. This is also why Tier 1 often gets overlooked. It doesn't look like AI. It doesn't promise breakthroughs every quarter. It just works. And that's the point. Tier 1 sets the floor. As robotics expands, someone has to build the machines that physically interact with the world. That creates real value, even if it's not the most dramatic part of the robotic story. But precise movement alone isn't enough. Robots only become transformative once they can understand what they're interacting with. And that brings us to the next tier. After this, I'll show you 2 more tiers of robotic stocks, and at the end, I'll combine all of them into a single portfolio, run the projections, and show you how this structure could potentially turn a $10,000 investment into a $10 million portfolio over the long run. But first, let's look at Tier 2, the eyes and nerves of robotics. Tier 2 is all about perception, cameras, sensors, and machine vision systems that translate the physical world into data a robot can understand. This is what allows robots to leave cages, operate safely around humans, and function in environments that don't behave the same way twice. And the company sitting here is Teledyne. This company builds advanced imaging and sensing technologies that give robots perception beyond human eyesight. Thermal imaging, infrared, multispectral sensors, tools that allow machines to see in darkness through smoke, fog, or visual noise. In robotics, this isn't about prettier images, it's about reliable perception when conditions are imperfect. That reliability is the key. A robot that can't see consistently can't operate autonomously. It either slows down or fails. Teledyne's strength is depth and integration. It doesn't just sell a camera, it builds the full perception stack, from sensors and optics to the software that turns raw signals into usable information. That end-to-end control is what makes perception dependable at scale. From an economic standpoint, Tier 2 compounds differently from hardware. As autonomy increases, the demand for high-quality perception accelerates. Every new robot deployed into a complex environment increases the value of better sensing. And unlike basic hardware, perception systems don't commoditize as quickly because failures are expensive and reliability matters more than price. That dynamic shows up in how the market views Teledyne. Analysts generally rate the stock a buy, with average targets implying high teens upside. That reflects steady confidence in its role as a critical supplier to automation, defense, and advanced robotics, rather than expectations of speculative hypergrowth. Tier 2 often sits in a sweet spot. It's more leveraged to autonomy than physical hardware, but less exposed to hype than pure AI narratives. As robots spread into warehouses, infrastructure, and outdoor environments, perception becomes a bottleneck, and companies that solve bottlenecks tend to benefit consistently. This is also where the handoff to the next layer begins. Seeing creates massive amounts of data. Every frame, every signal, every sensor reading feeds into a decision. But perception alone doesn't decide what to do next. For that, robots need intelligence that can process all of this information instantly and learn from it over time. For that, robots need a brain. This layer is where intelligence actually lives. Computing platforms, training systems, simulation environments, and orchestration software that decide how robots behave. It's the part of the system that turns raw signals into decisions, and decisions into learning. NVIDIA sits at the center of this tier, not because it builds robots, but because it provides the infrastructure that allows robots to think. Its hardware runs the models that interpret sensor data, plan movements, and react instantly to changing conditions. But the more important piece isn't just the chips, it's the ecosystem built around them. Modern robotics doesn't learn in the real world first, it learns in simulation. Before a robot ever touches a warehouse floor or a factory line, it can be trained through thousands of virtual scenarios. It learns how to navigate obstacles, handle edge cases, and respond to failures before those failures ever happen in reality. That compresses years of trial and error into weeks. This is where NVIDIA's advantage compounds. Its simulation and training platforms allow developers to create digital twins of real environments and train intelligence at scale. Every improvement made in simulation can be deployed instantly across fleets of robots in the physical world. Learning becomes centralized, fast, and repeatable.
This is also where skepticism naturally shows up. NVIDIA is already one of the largest companies in the world. It's reasonable to wonder how much upside is left when a company is already this big. That question makes sense, but it misses how platforms grow. When a company controls the intelligence layer, growth doesn't come from selling more units one by one, it comes from deeper integration. More use cases, more dependence on the same underlying system. As robotics spreads into new industries, the same intelligence gets reused again and again. That's why it makes sense to adjust expectations. NVIDIA's historical growth has been extraordinary, but forward-looking assumptions are more conservative. Even at a lower growth rate, the compounding power of owning the brain layer remains intact because margins, scale, and ecosystem lock-in behave differently here than in hardware. Analysts seem to recognize that distinction. NVIDIA is broadly rated a strong buy with average targets implying roughly 40% upside over the next year. That optimism isn't about chasing hype. It reflects confidence in NVIDIA's role as the default intelligence platform behind modern robotics and AI systems. Tier 3 is where the biggest value concentration tends to happen. Intelligence improves everything above and below it. Better models make sensors more useful and hardware more efficient. And as learning compounds, the gap between leaders and followers widens. But even the smartest intelligence doesn't create value on its own. It has to be deployed, coordinated, and turned into real-world efficiency. And that is where the final tier comes in. This is the layer most people forget when they think about robotics. When most people think about robotics, they picture machines being built or software being trained. What they don't focus on are the companies actually running robotics at scale every day as part of their core business. Amazon is the clearest example of that. Across its fulfillment and logistics network, Amazon operates one of the largest robotic systems in the world. Not a single robot type, but many of them working together. Robots moving shelves, robots sorting packages, robots navigating around people. All of it is happening simultaneously across massive facilities that never stop moving. The advantage isn't any one machine, it's how everything is coordinated. Amazon doesn't win because it owns robots, it wins because it integrates them. Inventory movement, routing, picking, sorting, all of it is managed through centralized systems that consistently rebalance flow. When conditions change, the system adjusts in real time. This is where robotics turns into operating leverage. Small improvements stack up fast. Faster picking reduces congestion. Better routing cuts handling. Fewer touches per order lowers costs and errors. On their own, those gains look minor. Applied across millions of orders, they become enormous. This is also why this tier is incredibly hard to copy. You can buy similar robots, you can license similar software. What you can't replicate easily is years of operational data, custom workflows, and systems that have evolved together inside a live business. That is where the moat forms. From an investment perspective, Tier 4 doesn't always look like a robotics story. Amazon isn't marketed as a robot company, but that's exactly the point. Robotics shows up here as a margin expansion, not product revenue. Faster delivery, lower costs, more resilient operations. Analysts tend to reflect that view. Amazon is broadly rated a strong buy, with average targets implying high 20s upside. That optimism isn't about robots as a product line, it's about operational leverage driven by automation, logistics efficiency, and scale. Tier 4 is where all the previous layers finally pay off. At this point, the 4 layers start to come into focus as parts of a single system rather than separate bets. What makes these 4 companies interesting isn't that they're all robotics stocks, it's that each one represents a different way to value compounding as robotics spreads through the economy. Boston Scientific sits at the foundation. It's about execution, precision, reliability, and steady adoption as robotics spreads. Teledyne sits one level up. Perception is what lets robots leave controlled environments. As autonomy increases, better sensing removes bottlenecks and accelerates progress. NVIDIA sits above that. Intelligence amplifies everything below it. Better models improve sensors and hardware at the same time, which is why this layer captures the most leverage over time. Amazon ties it together. Robotics here isn't a product, it's efficiency. Automation shows up as speed, cost control, and a stronger operating engine that's hard to copy. Seen together, these companies aren't competing with each other, they reinforce each other. Each layer depends on the ones below it and amplifies the ones above it. That's why two companies can both be exposed to robotics and still deliver very different outcomes over time. This is also where the idea of a potential 10 times outcome needs to be framed correctly. It's not about one breakthrough product or a single year of explosive growth, it's about owning parts of a system that compound over a long period as automation becomes the default way physical work gets done. So let's make a portfolio of these tiers and look at the future projections. At the base, Boston Scientific sits at 20%. Historically, over the past 10 years, this stock has delivered an average share price appreciation of 18.73%. Teledyne also sits at 20%. Perception compounds slightly faster because as robots move into messier environments, better sensing removes friction everywhere else. Historically, that's shown up as 19.97% average appreciation, driven by demand rather than hype. The largest weight goes to NVIDIA at 40% because this is where learning and leverage concentrate. Over the past 10 years, NVIDIA's share price appreciation has averaged 71.71%, but the company is already enormous. Instead of extrapolating that kind of growth forward, expectations are normalized. For projections, I'm using a more conservative 35% annual rate, which still reflects NVIDIA's scale, platform economics, and ability to reuse the same intelligence across multiple industries without relying on unrealistic growth assumptions. Amazon rounds it out at 20%. Historically, it has maintained a 20.9% average appreciation. Blended together, this structure produces an average annual return of 25.92%. To put that into perspective, a $10,000 investment compounding at that rate grows to $12,592 after 1 year. After 10 years, it's projected to reach $100,218, which is effectively a 10 times return on the original capital. And that is where most people would stop and take profits. But the more interesting question is, what happens if you don't? By 20 years, that same $10,000 is projected to grow to $1,004,371. That's roughly a 100 times outcome, driven entirely by staying invested as compounding accelerates. Keep going, and by 30 years, the projections show a valuation of $10,065,641. That notably crosses into a 1,000 times territory relative to the original investment. If this helped you think about money more clearly, stick with the channel. Everything here is built to make long-term investing feel simpler and more realistic.